Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. What if I told you that the single biggest threat to your investment portfolio isn't a market crash or a recession, but the person staring back at you in the mirror? Today, we're going to dive into why our own brains are practically hardwired to make terrible financial decisions and, more importantly, what we can do about it.
Let's kick things off with this absolute gem from the father of value investing himself, Benjamin Graham. This one sentence really sets the stage for everything we're about to talk about. He's basically saying it's not the stocks, it's not the economy, it's us. We are the problem.
And look, this isn't just some philosophical idea. The numbers are absolutely staggering. Over a 20-year period, the S&P 500 index returned over 8% a year. Pretty good, right? Well, the average person actually investing in those funds, they only made 1.9%. I mean, where did that other 6% plus just vanish? That gap, that huge difference, is the price we pay for our own behavior. Panicking when things get scary and selling low, then getting greedy and buying high.
So, how does this keep happening, and what in the world can we do about it? Well, in this explainer, we're going to break it all down. We'll start with our mental blind spots, take a trip back in time to see how our brains evolved, meet the two investors living inside your head, and then finally, figure out a better path forward.
Okay, so the first big hurdle we have to get over is something psychologists call the bias blind spot. And it's kind of funny, right? We are all experts, absolute pros at spotting irrational behavior and dumb decisions in everybody else. Our friends, our family, oh yeah, we see it. But when it comes to ourselves, we're pretty convinced we're the exception to the rule.
So why do we all fall into these same traps? Well, the fundamental reason is that our brains are basically running on ancient software. I mean, the hardware we've got in our heads was designed for survival on the African savannah 150,000 years ago. It was not designed for the New York Stock Exchange. Just think about it for a second. Our brains are hardwired for instant life or death decisions. Is that noise in the grass a lion we need to run from, or is it an antelope we can hunt for dinner? That fight or flight instinct was absolutely perfect for dodging predators, but when you apply that same instinct to market volatility, it is a complete and utter disaster. It sets up this constant battle raging inside our own heads. A really great way to think about how our brain operates is to imagine two competing systems, and the book uses this brilliant analogy from Star Trek that just nails it. You've got the logical, calm Mr. Spock on one shoulder and the emotional, hot-headed Dr. McCoy on the other. Now, we all like to think we're Mr. Spock, cool, calculating, and driven by pure logic. But let's be honest, our default setting is Dr. McCoy. That's our X system. It's emotional, it's automatic, it's effortless. It's that gut reaction. Our inner Spock, the C system, is logical and deliberate, but it takes real conscious effort to fire him up. And most of the time, McCoy is running the show.
And here's the kicker. From an evolutionary standpoint, your brain is literally wired from McCoy to override Spock. You know, when that snake lunges, you jump back before your logical brain even has time to process that it's behind a thick pane of glass at the zoo. For survival, a false positive, jumping away from a harmless snake, is way, way better than a false negative.
So just how good is your inner Spock at stepping in when your inner McCoy takes over? You know what? Let's find out. I'm going to throw 3 quick questions at you from what's called the cognitive reflection test. It's specifically designed to see if your logical brain can catch and correct your gut reaction. Ready? Feel free to pause and think about this one. An answer probably jumped in your head immediately. The question is, was that your McCoy or your Spock talking?
Okay, here's the second one. Again, think it through carefully. Your gut probably has a fast answer. Your C system's job is to stop and ask, hang on a second, does that really make sense?
And here's the last one. The answer might seem super obvious, but that's often a dead giveaway that your fast, intuitive X system has grabbed the steering wheel.
Okay, let's break down that first question. If you immediately thought 10 cents, don't worry, that's what almost everyone says. That is your McCoy shouting out an answer. But if you let Spock take over for just a second, if the ball is 5 cents and the bat is $1 more, that makes the bat $1.05. Add them together, and you get $1.10. It's a perfect, simple example of how our intuition can lead us astray and how just a moment of reflection gets us to the right answer.
So here are all the correct answers. For the widgets, if 5 machines take 5 minutes to make 5 widgets, it just means each machine takes 5 minutes to make one. So 100 machines can make 100 widgets in that same 5 minutes. And for the lily pads, well, if they double every day and cover the whole lake on day 48, they must have covered half the lake the day before, on day 47. The whole point here is that our first intuitive guess is very often wrong.
Now, if you struggle with those, please do not feel bad. You're in very, very good company. Only about 17% of people get all three right. And get this, even among professional investors, only 40% ace the test. At MIT, a campus full of brilliant people, it's less than half. This just goes to show how powerful and dominant our automatic emotional brain really is for all of us.
Now, you might be sitting there thinking, hey, I aced that test, I'm safe. But not so fast. Because here's the twist. The book makes a powerful case that even being super intelligent and having strong willpower isn't enough to save you. There's a critical flaw.
This one experiment shows it perfectly. Researchers had people skip a meal so they'd show up hungry. Then, they put one group in a room with a plate of radishes and a plate of warm, fresh-baked chocolate chip cookies that they were forbidden to eat. Afterwards, everyone was given a really tough puzzle to solve. The result? The group that had to use all their mental energy to resist those cookies, they gave up on the puzzle in less than half the time as the other groups. The takeaway from this is huge. Willpower is not an infinite resource. It's like a muscle that gets tired or a battery that drains. Every time you use it, resisting that donut at work, staying patient in traffic, you're using up a little bit of it. By the time you sit down to make a big investment decision at the end of the day, your self-control could already be running on fumes.
So if we can't just be smarter than everyone else, and we can't just rely on having ironclad willpower, what on earth is the answer? Well, this brings us to the final and I think most important idea of the whole book.
And who better to learn from than Warren Buffett himself? He famously said that success in investing has almost nothing to do with IQ. Once you're past a certain point, what you really need is the right temperament, the ability to control those deep, powerful urges that get everyone else into so much trouble. So here it is, the bottom line. You cannot outthink your own brain. You're not going to win a battle of wits against your own evolutionary wiring. Your emotional, automatic X system will always be there. So the solution isn't to try and be smarter or to just try harder. It's to build a better process, a system with rules and checklists that acts as a guardrail, protecting you from your own worst impulses.
And that leaves us with the most important question of all, a question for you to really think about. Knowing that your own brain is the biggest risk in your portfolio, what kind of system are you going to build to protect yourself from yourself? How will you make sure you become your own best ally instead of your own worst enemy?
You know that feeling, right? You make a perfect, rational plan for yourself, and then it's like a totally different person shows up and just wrecks it all. You plan to eat a healthy salad, but that guy orders the pizza. You plan to go to bed early, but that person stays up binge-watching just one more episode. It really feels like we have two different people living inside our heads. Well, it turns out that's actually kind of true. Today, we're going to explore that weird, strange disconnect between your calm, logical self and your impulsive, in-the-moment self. Okay, so let's just dive right in with a quick thought experiment. Picture this. You are lost in the woods. The sun is beating down, you're starting to get really worried, and you suddenly realize you forgot to pack both food and water. It is an absolute nightmare scenario. So right now, in this moment, which mistake feels worse? Forgetting the food or forgetting the water? Just what does your gut say?
And here's the crazy part. The answer you just gave, it probably has almost nothing to do with an actual survival situation, and everything to do with how you feel this exact second. If you happen to be a little thirsty right now, I bet you said water. If you just chugged a glass of something, maybe food seemed like the bigger deal. This simple little bias is a perfect window into a massive glitch in how we think.
And that glitch, it has a name. It's called the empathy gap, and it's basically this fundamental flaw in our ability to do what you might call emotional time travel. You know, the skill of accurately predicting how we're going to feel, think, and act when we're in a totally different state of mind in the future.
So here's how it works. When we're in a cold state, calm, rational, thinking clearly, we are remarkably bad at predicting our own behavior for when we get into a hot state. Angry, excited, hungry, you name it. We basically have zero empathy for our future self. We just assume that future version of us is going to be just as logical and level-headed as we are right now. And that, my friends, is a huge mistake.
And hey, this isn't just some vague theory. It is backed up by some absolutely fascinating real-world data. Remember that question about being lost in the woods? Well, some researchers decided to put it to the test in a place where people's physical states change dramatically, the gym.
And the results were, wow. They were stark. They asked one group the question before their workout, when they were all cool, hydrated, and in that cold state. 61% of them said they'd regret forgetting water more. But then they asked another group the same exact question after their intense workout, when they were hot, sweaty, and desperately thirsty. For that group, the number just shot up to a staggering 92%. Their immediate physical need completely warped how they saw the problem.
Now, this gap in understanding ourselves, it doesn't just apply to basic physical needs like thirst. Oh no, it gets much more personal, way more complicated, and frankly, a lot more interesting when it comes to human desire.
So researchers Dan Ariely and George Lowenstein conducted this now famous and maybe slightly blush-inducing experiment. They had a group of male college students rate their interest in a whole bunch of different sexual scenarios and activities. First, they did this in a cold state, just sitting calmly in a classroom. Then, they were asked to answer the exact same questions all over again, but this time in private, while they were in a sexually aroused or hot state.
So in the cold light of day, when the men were asked to just predict their future interest, the average arousal rating they gave was 35%. This is the rational brain making a calm, measured forecast about what it might want later. Seems pretty reasonable, right?
But in the heat of the moment, that number absolutely skyrocketed to 52%. I mean, that's not a small jump. It's a colossal leap of 17 percentage points. This just brilliantly shows the gap. The cold brain simply could not comprehend the power and influence of the hot brain. They were effectively two totally different decision makers. The rational you and the aroused you are practically strangers.
And this disconnect, it doesn't just happen in these really extreme states like intense thirst or arousal. It sabotages us in far more common, everyday ways. And one of the biggest, most universal culprits is, of course, procrastination.
Ugh, this is a trap we all fall into. It's Sunday evening, you're all relaxed, and you map out this perfect, productive week. I'm going to wake up at 6 a.m., hit the gym, tackle that huge project. Your calm self genuinely believes that your Monday morning self will share this same enthusiasm. But you're failing to empathize with the tired, groggy, overwhelmed person you will actually be when that alarm goes off. That right there, that is the empathy gap in action.
And of course, you know, there's an experiment for this too. Researchers gave students a proofreading task. They offered them 3 different ways to handle deadlines. They could set their own 3 deadlines, have one big deadline at the very end, or be given 3 strict, equally spaced deadlines that were just imposed on them. Which one do you think worked out the best?
The results are just so incredibly revealing. Take a look at the group with the strict, imposed deadlines. They performed the best across the board. They found the most errors, and they were the least late. Now compare that to the group most people would probably choose, that one single deadline at the end, the one that gives you maximum freedom. Well, they performed the absolute worst, finding the fewest errors and being nearly 3 times later than the other group. We think we can manage ourselves, but the evidence is crystal clear. Our calm self is a terrible manager for our future self.
Okay, so this might all be sounding a little bleak. Are we just doomed to be sabotaged by our future emotional selves forever? No, absolutely not. Because once you understand the glitch, you can exploit it. There is a weapon we can use against this flaw, and it is a remarkably powerful one.
The answer lies in this old military adage. The whole strategy is to do all the important thinking and decision-making before you're in the heat of the moment. You use your calm, rational, cold state brain to build guardrails that your emotional, impulsive, hot state brain just has no choice but to follow.
This strategy is called pre-commitment. And it's really the art of locking your future self into a course of action that you've chosen in advance. You consciously acknowledge the empathy gap. You accept that your future self is going to be tempted or tired or panicked, and so you make the important choices for them now, while you're still the strong one.
And to see just how powerful this strategy can be, let's look at a very high-stakes example from the world of investing, where controlling your hot state emotions can be the difference between making a fortune and losing everything. The legendary investor Sir John Templeton built his entire career on this one simple yet profoundly difficult principle. In a calm, rational moment, everyone agrees with this quote. I mean, it's obvious, right? But actually doing it when everyone around you is panicking, that is a whole different ballgame.
It's because when the market is crashing, your hot state just takes over. Your rational plan to buy low gets completely hijacked by this primal fear. Your calm, logical self, the one who made the plan, simply cannot empathize with the sheer terror you will feel while watching your life savings seemingly evaporate. This is the investor's empathy gap, and it costs people fortunes.
So how did Templeton overcome this? He built this brilliant system based entirely on pre-commitment. In a cold state, when markets were totally stable, he'd do his research. He'd identify great companies he wanted to own and calculate the bargain price he'd be absolutely thrilled to pay. Then, and this is the masterstroke, he would place standing buy orders with his broker at those prices. So when a market panic inevitably hit and prices plummeted, his orders would just trigger automatically. His emotional panic self was completely removed from the equation. Genius.
And look, this is a strategy that goes far beyond billionaire investors. You can use this to improve your health, to boost your productivity, to secure your finances. It's all about acknowledging your own predictable irrationality and then building a smarter system to protect yourself from, well, from yourself.
So let's just bring it all together. You essentially have two cells, a hot one and a cold one, and they are terrible at understanding each other. This is the empathy gap, and it's the root cause of so many bad predictions and broken resolutions. The single most powerful tool you have to fight this is pre-commitment. You use your calm, rational brain to design choices and build systems that your future emotional brain is just forced to obey.
And this brings us to the final and most important question. Think about your own life, your diet, your exercise habits, your spending, your work. Where does your hot self constantly sabotage the plans of your cold self? And more importantly, what one pre-commitment could you make today to build a better system that protects you from that person tomorrow?
So, let's talk about something that trips up pretty much every investor at some point. Why is it that we so often make the worst possible decisions, or just freeze up, right when the best opportunities are staring us in the face? Well, we're going to dive into the psychology of fear, how it completely hijacks our financial brain, and it all starts with a surprisingly simple game. Okay, to really get what's going on here, I want you to play a little game with me, in your head. It's a really simple setup, but the way people actually play it tells you almost everything you need to know about our crazy relationship with risk and loss. You ready? Okay, so here are the rules. You start with $20. There are 20 rounds in the game, and in each round, you have a choice to make. You can either invest $1 or you can sit this one out. If you decide to invest, we flip a coin. If it's heads, you win $2.50. If it's tails, you lose your $1 investment. That's it. Pretty simple, right? The odds are clearly heavily stacked in your favor. So if you just look at the math, the winning strategy is, well, it's a total no-brainer. You should absolutely invest every single time. I mean, why wouldn't you? The potential upside of $2.50 is way, way bigger than the potential downside of $1. The math is screaming at you to play. In fact, check this out. If you play the smart way and you invest in all 20 rounds, your total expected payout is $25. That's a $5 profit. And get this, the odds of you actually walking away with less money than you started with, it's only about 13%. So logic says you play every round, period. But here's where it gets really fascinating. When actual researchers ran this exact experiment with real people, with real money on the line, that perfect logical strategy just got tossed right out the window. So what do you think happened? The researchers had 3 groups of people. The first group was really unique. They had a specific kind of brain damage that made them unable to process fear. The second was just a group of normal folks. And the third had brain damage that had nothing to do with their emotions. Now look at these results. The no fear group played almost perfectly. They invested 84% of the time. But the normal group, they only invested 58% of the time. They left a huge amount of expected money just sitting on the table. And yeah, that gap is already pretty big. But that's not even the jaw-dropping part. No, the real shocker came when the researchers looked at what people did in the round immediately after they lost $1. And wow, look at this. It's like 2 different worlds. After losing, the no fear group didn't even flinch. They just kept on playing the odds, investing 85% of the time. They correctly saw that the last coin flip had nothing to do with the next one. But the other 2 groups, they just fell apart. The sting of that $1 loss was so powerful, their investment rate cratered to less than 40%. Fear completely overrode the winning strategy. And this is the perfect analogy for how we act in a bear market. When asset prices are falling, when stocks are on sale, that's logically the absolute best time to be investing. But because we've all just suffered losses, that fear kicks in and it paralyzes us. We can't bring ourselves to buy the bargains that are literally right there in front of us. So what is going on here? Why do our brains, our perfectly logical brains, just short circuit like this? Well, it turns out there's a battle for control going on inside our own heads, a kind of brain drain where our logical minds get completely hijacked. Psychologists often talk about two big systems for how we think. You've got the C system, which is your conscious, logical brain. It's the part that does the math. It's deliberate and analytical, but it's also slow and it takes a lot of energy. Then you have the X system. That's your intuitive, emotional, gut feeling. It's lightning fast, it's automatic, and it's the one that takes over when we're tired, stressed, or scared. Now, to test this theory, researchers used a clever tool called the Stroop test. You've probably seen this before, right? You see the word red, but it's printed in blue ink, and you have to force yourself to say blue. It's weirdly hard and it's mentally exhausting. The whole point is to just wear out that logical C system, to simulate a high-stress situation and force your brain to rely on that fast, emotional X system. And the results? Whoa, they are just unbelievable. Before the stress test, both the logical thinkers and the intuitive thinkers invested about 70% of the time, pretty similar. But after the Stroop test drained their mental batteries, the logical C-system thinkers actually got better. They invested 78% of the time. But the intuitive X-system thinkers, they just completely fell apart. Their investment rate dropped like a rock to just 49%. It's proof that when the pressure is on, our gut feelings can be dead wrong. And this isn't just some weird thing that happens in a lab. No, this exact dynamic plays out in the real world, with trillions of dollars on the line. It causes this trap that one legendary investor calls terminal paralysis. And there is no better or more terrifying example than what happened during the 2009 financial crisis. So let's just set the scene for a moment. Starting in late 2007, the market just went into a complete freefall. For well over a year, investors were just battered by wave after wave of terrible news and devastating losses. It all came to a head at the market bottom in March of 2009. The scale of this collapse was just staggering. The S&P 500 lost 57% of its value. Just let that number sink in for a second. The entire market cut in more than half. Can you imagine living through that? The stress, the fear, the mental exhaustion, it was the ultimate real-world Stroop test, and it drained the willpower of an entire generation of investors. And the legendary investor, Jeremy Grantham, he had the perfect and honestly a pretty terrifying name for what was happening. He called it terminal paralysis. He said that right at the moment of maximum pain and pessimism, people just become catatonic. They're so paralyzed by fear they just sit there and pray, completely unable to act, even when some of the greatest bargains in a generation are staring them in the face. So what's the antidote? Well, another investing giant, Seth Klarman, he spelled it out. He said that the correct move, which is also the hardest move imaginable, is to put your money to work in the middle of the panic. You have to buy while things still look absolutely awful, accepting that they might even get worse before they finally get better. You literally have to fight every single emotional instinct in your body. So, how in the world are you supposed to do that? How do you fight your own brain when it's screaming at you to run for the hills? Well, there is a cure, and it's all about forging your battle plan before the battle ever begins. Okay, so let's name the villain of our story, right? Terminal paralysis. It's that awful, fear-induced state where you're just frozen, you're unable to act, even when you know, logically, that you're looking at a historic buying opportunity. It is your emotional X system hijacking your financial future. And as Jeremy Grantham pointed out, there really is only one cure. It's not about trying to be braver in the moment. It's not about being smarter when everyone is panicking. The only cure is pre-commitment. It's about making your most important decisions long before you have to. So this is your playbook. Step 1, you create the plan now, while you're calm and rational, while your logical C system is in the driver's seat. Step 2, you define clear, objective triggers for when you're going to invest. Step 3, you commit ahead of time to a few large, decisive moves. And then step 4, and this is the most important part, when those triggers get hit, you execute the plan. No second guessing, no hesitation, especially when it feels absolutely terrifying. You have to trust the plan that your calm self made for your panicked self. And look, you can make it way easier to actually follow that plan by not putting yourself in a super stressful position to begin with. You can take a page out of Seth Klarman's book, always hold some cash so you have the dry powder to act on opportunities, have a clear, unemotional discipline for when you sell things, and maybe most importantly, avoid using too much leverage, because that's what can force you to sell at the absolute worst possible time. These steps just reduce the chances of your emotional brain having to make a bad decision under pressure. At the end of the day, what all of this research really shows us is that fear is an instinct, not a financial plan. Reacting to it is a recipe for failure. The only way to win this game is to have your plan ready to go before the panic ever starts. So the question I want to leave you with is this: what's your plan?
All right, welcome back. Today, we're diving into a chapter called Always Look on the Bright Side of Life. And if you know that song, you know it's sung by guys being crucified. It's the perfect, kind of dark, kind of funny start for our look into the power and the peril of optimism. So to kick things off, I've got a couple of questions for you.
First one, be honest with yourself. When you're behind the wheel, compared to every other person out on the road, are you better than average?
Okay, how about this one? What about at work? Think about your colleagues, your peers. In your profession, are you in the top half?
Well, if you said yes to either of those, you are not alone. In fact, you're in the overwhelming majority. It's kind of funny, isn't it? Almost everyone thinks they're better than average. Today, we're going to unpack exactly why that is.
So, here's what we're going to cover. First, we'll look at the data that shows how confident we all are. Then we'll ask if our brains are just hardwired for this stuff. We'll get into the whole nature versus nurture debate. Look at the very real dangers of too much hope, and finally, arm you with a skeptic's mindset to fight back. Let's jump right into section 1. Are you above average? Because this feeling we all have, it's not just a hunch. No, it's a measurable phenomenon, and it shows up in some pretty wild places.
For example, check this out. Somebody went and asked over 600 professional fund managers if they were above average at their jobs. A whopping 74% said yes. Now think about that for a second. Investing is mostly a zero-sum game, right? For every winner, there's a loser. And yet nearly 3/4 of these pros think they're the ones who are going to win. And it is not just in finance. Get this, about 80% of students think they'll finish in the top half of their class. I mean, the math just doesn't work. It really shows you how deep this optimistic view of ourselves goes. And you know what? It gets amplified by this weird little quirk in our brains. And that quirk has a name: the illusion of control. It's this belief we have that we can steer events even when we have absolutely no influence over them. We start to think randomness is skill, especially when there's a lot of information and choices involved, which, if you think about it, sounds an awful lot like investing, doesn't it? This one experiment just shows it perfectly. They asked people how much they'd sell a lottery ticket for. If the ticket had random numbers, they'd sell it for about $1. But if they got to pick their own numbers, suddenly they wanted 4 times as much. The odds of winning are identical, but just the act of choosing made them feel like they had some kind of control. So let's dig deeper and see just how hardwired this really is.
Okay, section 2, the optimism default. So we've established that we're all a bit too optimistic. The big question is, why? Is it possible our brains are just built for hope right out of the box?
Well, psychologists have this theory about our brains having 2 systems. There's the slow, analytical C system, and then there's the fast, intuitive, emotional X system. The theory is that optimism is the factory default setting for that fast, intuitive X system. And to prove it, they designed a clever experiment where they basically forced people to use it by adding a ticking clock.
So here's how it worked. People saw different future life events flash on a screen, some good, some bad. All they had to do was decide if that event was going to happen to me or not me. But here's the twist. Some people got a full 10 seconds to decide, while others only got 1 second, just a gut reaction. And the results are fascinating. When people had time to think, they figured about 4 out of 6 good things would happen to them. Pretty optimistic, right? But when they were forced to answer in just 1 second, that number shot up to 4.75. Taking away their ability to think made them even more optimistic. This is huge.
It really suggests that optimism isn't something we choose. It's just our brain's first automatic response.
All right, on to section 3, nature, nurture, and bias. So we know our brains default to a rosy outlook. But where did that default come from? Is this a case of nature or nurture? Were we born this way, or did we learn it?
Well, let's start with the nature argument. An anthropologist named Lionel Tiger came up with this really cool evolutionary theory. He said, look, when early humans started hunting, it was insanely dangerous. A pessimist would weigh the risks, getting gored, starving, and would probably just stay home. But the optimist would say, yeah, I can take on that giant woolly mammoth. Over thousands and thousands of years, that tendency to just go for it, to persevere, became a crucial survival trait.
But of course, it's not all nature. Let's switch over to the nurture side with this killer quote from Warren Buffett. Never ask a barber if you need a haircut. I mean, it's perfect, right? It perfectly sets up this idea of self-serving bias, our natural tendency to believe things that, well, benefit us.
And this number really shows you how powerful that bias is. In a study, professional auditors were given 5 really ambiguous accounting cases. They told half the auditors they were working for the company, and the other half they were working for an outside investor. The result? The auditors who were told they worked for the company were 31% more likely to sign off on the dodgy accounting. Their professional judgment just went out the window because of whose side they thought they were on. And that brings us to a really important turn. Section 4, the dangers of hope. Look, being an optimist might be a fantastic strategy for life. It helps you get up in the morning, but as an investment strategy, hope can be absolutely terrible.
The investing legend Ben Graham was warning people about this decades ago. He said the biggest, most painful losses don't come from buying great companies when times are tough. No, they come from buying lousy companies when times are great. And why is that? Because when everything's going well, our optimism just goes into overdrive. We start thinking the good times will never end.
And you know who loves that? Wall Street. They are more than happy to feed our natural optimism. A lot of stockbroker research kind of runs on these 3 unwritten, self-serving rules. Rule 1, all news is good news. If it's bad news, don't worry, it's about to get better. Rule 2, everything is always cheap. If it's not, we'll just invent a brand new valuation metric to make it look cheap. And Rule 3, my personal favorite, assertion trumps evidence. Basically, never let the facts get in the way of a good story.
So let's recap. We're hardwired for optimism, and the entire financial industry is basically designed to exploit that fact. What in the world are we supposed to do? Well, that brings us to our final section, a skeptic's mindset. This is the practical antidote to our own biased brains.
Okay, if you remember one thing from this entire explainer, make it what's on this slide. It all comes down to changing your default question. See, the optimist inside all of us, our default brain, asks, can I believe this? And then it goes looking for any shred of evidence, any excuse to say yes. But the skeptic, the disciplined investor, asks a very different question. Must I believe this? That question demands overwhelming, undeniable proof before you commit a single dollar.
Now, before we finish up, I want to leave you with one last, kind of unsettling idea. It's a real thing called depressive realism. It's a hypothesis, and there's some real evidence for it, that the only people who truly see the world without that rosy, optimistic filter are people who are clinically depressed. They don't have the illusion of control, they don't have overconfidence, they see things exactly as they are.
And that leaves us with this final thorny question. As an investor, what's the better choice? To be happy but maybe a little bit deluded, or to be depressed but completely realistic? Maybe the real answer is to be a clear-eyed skeptic with your portfolio and then go home and allow yourself to always look on the bright side of life. Definitely something to think about.
You ever flip on the TV and see some financial guru just oozing confidence, telling you exactly which stock is going to be the next big thing? And for a second, you think, man, this guy sounds like he knows everything. We put so much faith in experts, right? But what if that's a huge mistake? Today, we're going to pull back the curtain on overconfidence, especially expert overconfidence, and see why it's so incredibly dangerous for our wallets.
But hey, before we start pointing fingers, let's turn the mirror on ourselves for a second. Let's do a super quick pop quiz, just to see how well calibrated your own confidence really is. You ready?
All right, the rules here are really simple. I'm going to throw a few questions at you. For each one, all you have to do is give me a range, a low number and a high number. The key is you need to be 90% sure that the real answer falls somewhere inside your range. Not 100%, but a solid 90%. Got it? Okay, first one. What was Martin Luther King Jr.'s age when he died? Go ahead, think of a low number and a high number. Lock in that range you're 90% sure about. Next up, how long is the Nile River in miles? This might be a tough one, so feel free to make your range pretty wide, just as long as you're 90% confident the correct answer is in there somewhere. All right, question number 3. How many books are in the Old Testament? Give me your high and low guess. And for the last one, what year was Wolfgang Amadeus Mozart born? Take a moment, think about it, and write down that 90% confidence range. So, how'd you do? Now, in a longer version of this quiz with, say, 10 questions, most people are pretty shocked to find out that 4, 5, sometimes even 7 of their ranges totally miss the mark. You'd think, if you're 90% sure, you'd only miss 1 out of 10, right? Well, that gap is overconfidence in a nutshell. We all have a natural tendency to believe we know a little more than we actually do. But here is the absolute kicker. This is the whole point of our discussion today. As overconfident as we might be, the so-called experts we listen to, they are often way, way worse. And when it comes to your money, that kind of misplaced confidence isn't just wrong, it's incredibly expensive. So here's what we're going to do. We're going to put expert advice on trial. We'll kick things off by comparing weathermen to doctors. Then we'll look at the psychology behind why we just blindly follow authority. We'll see how investors stack up. We'll calculate the actual price of being overconfident. And we'll explore the crazy game of trying to outsmart the market. And finally, we'll deliver a verdict on what all this means for you. Okay, first up, to really get a handle on this expert problem, we need to compare 2 very different professions. Let's call it a tale of 2 forecasters, the weatherman versus the doctor. You know, the big difference between them boils down to just one thing: feedback. Think about it. A meteorologist says there's a 50% chance of rain. Well, the next day, they can look out the window and see if it rained. They get constant, clear, immediate feedback. And because of that, they're actually really well calibrated. But doctors? Their feedback is terrible. A patient might just get better on their own, or they might see a different doctor. The original doctor often never finds out if their diagnosis was right or wrong. And that broken feedback loop creates this huge, dangerous gap between how confident they feel and how right they actually are. And this is where it gets really scary. So, when you ask a doctor how sure they are about a diagnosis, they might say something like, "I'm 90% confident." And let's be honest, we want to hear that, right? It makes us feel better. But get this, studies have shown that when doctors say they're 90% sure, they're actually right only about 15% of the time. Just let that sink in for a second. That's a 75-point gap between their confidence and reality. It's just a shocking example of how, without good feedback, overconfidence can run completely wild. So let's build on that, because the problem isn't just that the experts are overconfident. The other side of the coin is that our own brains are basically hardwired to stop thinking critically and just follow their lead. To really understand this, we have to talk about one of the most famous and, frankly, most disturbing experiments in the history of psychology, Stanley Milgram's obedience study. He wanted to figure out how far regular people would go when an authority figure told them to do something that went against their conscience. What he found was pretty dark. The setup was pretty straightforward. You have the real test subject, called the teacher, sitting in front of a big machine with a bunch of switches. An actor in a lab coat, the authority figure, tells them to give electric shocks to another person, the learner, in the next room whenever they get a question wrong. And those switches were labeled all the way from slight shock up to danger, severe shock, and finally just XXX. The results? They were just horrifying. Even when the learner was begging to be let out of the experiment, 100% of people kept going. Even after hearing what sounded like agonized screams, 80% of them still obeyed the man in the lab coat. And a mind-blowing 62% of people went all the way to the end, flipping that final 450-volt switch. It shows we have this deep, primal instinct to obey authority, even when our gut is screaming at us not to. Okay, so what does this have to do with finance? Everything. When an expert in a suit and tie on TV tells you to buy a stock, that obedience instinct kicks in. Our critical thinking tends to shut down. So that leads us to the big question. When it comes to predicting stocks, are financial professionals more like those well-calibrated weathermen or those dangerously overconfident doctors? Well, the verdict is in, and folks, it is not pretty. One famous study had professional investors go head-to-head with a bunch of psychology students picking stocks. Now, of course, the pros were made more confident, but the results? They were right less than 40% of the time. That's worse than the students, who were basically just flipping a coin. In fact, on the stocks they were 100% certain about, the pros were right less than 12% of the time. They actually make the doctors look good. And this isn't just some funny little academic game. This overconfidence has a massive, real-world price tag. Because when you think you have some special insight, you can't help but act on it. You trade more, you chase hot tips, you're constantly tinkering. And all of that activity, it just eats away at your returns. A huge study looked at the actual brokerage accounts of tens of thousands of real investors. And the results were crystal clear. The people who traded the least, the buy and hold crowd, they did great. They pretty much matched the market's return of 18% a year. But the most active traders, the ones who were constantly buying and selling, thinking they could beat the market, their returns were less than 12% a year. Their overconfidence literally cost them a third of their potential gains. So why did people do it? This constant need to trade comes from this one very human belief, that you're smart enough to outwit everybody else. And you know who understood this perfectly? The brilliant economist John Maynard Keynes. He came up with the perfect analogy for it. Keynes said that picking stocks isn't like picking the face that you think is the prettiest. No, it's like a newspaper beauty contest where the winner is the person who picks the face that the average person will find the prettiest. So you're not judging the stocks, you're trying to judge the judges. You're trying to guess what everyone else is going to guess. It's a second guessing game. You can see this play out in a modern version of Keynes's game. Imagine this. You ask over 1,000 professional investors to pick a number from 0 to 100. The winner is whoever's guess is closest to 2/3 of the average guess of everyone playing. I mean, talk about trying to read 1,000 other minds. The guesses were all over the map. The average guess ended up being 26, so the winning number was 17. Here's how the thinking is supposed to work. A level 0 thinker just picks 50, right in the middle. A level 1 thinker assumes everyone else is a level 0 thinker, so they guess 33, which is 2/3 of 50. Then a level 2 thinker anticipates that and guesses 22. And you can actually see spikes in the data at 33 and 22. But the winner was 17. And you know how many of those 1,000+ pros picked it? 3. Just 3. The lesson here is pretty simple. Trying to stay one step ahead of the crowd is a nearly impossible game to win. Okay, so we've seen that experts are wildly overconfident, that our own brains are wired to blindly obey them, and that trying to outsmart the market is a fool's errand. So, after all that, what on earth are you supposed to do with your money? Well, the good news is the answer is incredibly simple, though it's not always easy to do in practice. First, just stop listening to the talking heads on financial news. Seriously. Second, build an investment plan that makes sense for you, and then have the discipline to stick with it. Third, you have to ignore what everyone else is doing. And finally, the next time you see a so-called expert give a hot stock tip, the best thing you can do for your portfolio is just put your fingers in your ears and hum a little tune. So I'll just leave you with this one question to think about. And this applies to everything, not just your money. When you're listening to someone, ask yourself, are you being swayed by their confidence? Or are you looking for actual proven competence? Knowing how to spot the difference might just be the most valuable investment you ever make. Thanks so much for watching.
Today, we're going to talk about something that feels totally central to investing: forecasting. Trying to predict the future. But what if I told you it's not just hard, but it's actually a trap? We're going to dig into why trying to guess what's next might just be the biggest mistake any of us can make.
This isn't some new idea. Let's go way back, like over 2,500 years ago. The philosopher Lao Tzu said it plain and simple. Those who have knowledge don't predict. Those who predict don't have knowledge. He was basically saying that true wisdom and trying to guess the future are two totally different things. They just don't mix. Pretty wild to think about, right?
And yet, you look around today and what do you see? The entire, massive, modern investment world seems to be built on doing the exact opposite. It's completely obsessed with predictions, price targets, earnings forecasts, economic outlooks. It's all about playing financial fortune teller. So right there, you've got this huge clash between ancient wisdom and how things are done now.
So let's get into it. Why is everyone so obsessed with this? Well, it turns out it's not just some bad habit we all picked up. The very tools and methods they teach in business school, the ones everyone uses, pretty much force you to put on your wizard hat and gaze into a crystal ball.
You don't have to take my word for it. Listen to the legend, Charlie Munger. He just nails it here. He's talking about the discounted cash flow model, which is like the holy grail of valuation. It looks so smart, right? So mathematical. But Munger sees right through it. He calls it false precision because at the end of the day, it's just a bunch of guesses about the future that you've plugged into a fancy spreadsheet.
And here's where it really falls apart, and it's just simple math. Let's pretend you're an amazing forecaster. I mean, you're genius. You're right 70% of the time. But to make a good investment decision, you often need a whole chain of predictions to be right. You need to be right about the economy, and about interest rates, and about the industry, and about the specific company. Well, you just multiply those probabilities together, and your chances of getting the whole thing right plummet to just 24%. One wrong link, and the whole chain snaps.
Okay, so the theory is shaky at best. But what about in the real world? How do these forecasts actually perform? Well, let's look at the data, the hard evidence. And I'm not kidding. The track record here isn't just bad, it's absolutely overwhelmingly terrible.
Let's start at the very top. The big picture economists, the smartest people in the room, supposedly. Their track record? They've managed to miss not one, not two, but every single one of the last 4 recessions. They didn't see them coming. And what's crazier is, in some cases, they didn't even realize a recession had started when we were already in it.
All right, now let's zoom in from the whole economy down to a single company. Say a Wall Street analyst makes an earnings forecast for a company 2 years from now. What do you think their average error rate is? It's a jaw-dropping 94%. I mean, think about that. Their guess is basically 100% wrong on average. Now you might be thinking, okay, 2 years is a long way out. That's tough. Fair enough. But what about when they only have to look out 12 months? Just 1 year. Surely they do better, right? Well, they're still off by an average of 45%. It's just, they really have no idea what a company is going to earn.
This chart really tells the whole story. Some researchers did this brilliant study. They looked at analysts' 5-year growth forecasts. They took the group of stocks that analysts predicted would be the fastest growing and the group they said would be the slowest growing. Then they just waited to see what actually happened. And the result? You can see it right here. There was literally no difference. The fast growers grew at the same rate as the slow growers. The analysts had absolutely zero predictive power.
And just one last example, but it's a doozy. Let's talk about price targets. Think back to 2008. The financial world is literally on fire, about to collapse. And what was the consensus forecast from the experts? They predicted the market would go up by 24% that year. So what happened? The market crashed by almost 40%. They weren't just a little bit wrong, they were catastrophically, spectacularly wrong, in the worst possible way.
So this brings up the million-dollar question, doesn't it? If the track record is this bad, if the evidence is so clear, why on earth does this whole prediction industry keep going? Why does it even exist? Well, the answer isn't in the numbers. It's in our heads. A researcher named Philip Tetlock did this amazing long-term study on so-called experts, and he found their predictions were barely better than flipping a coin. But here's the crazy part. When he went back and showed them how wrong they were, they hadn't lost an ounce of confidence, not one bit. Instead, they had this whole menu of excuses ready to go, things like, oh, I would have been right if only this had happened, or my timing was just a little off. And my personal favorite, I'm not wrong, it just hasn't happened yet. It's these little psychological tricks that let them feel like experts, even when they're failing all the time. Okay, so that explains why the experts keep making forecasts. But why do we as investors keep listening to them? Well, a huge part of it is this weird little glitch in our brains called anchoring. It's a subconscious thing where our minds grab onto the very first piece of information we hear, the anchor, and then all of our other thoughts and decisions get stuck around that initial number. There's this incredible experiment that shows just how powerful this is. They got a bunch of professional fund managers together. First, they asked them to write down the last 4 digits of their own phone number. Easy enough. Then, they asked them to estimate how many doctors there are in London. The result is just mind-blowing. The managers whose phone numbers ended in high digits, like above 7,000, gave a much higher estimate of doctors. Those with low-ending phone numbers gave a way lower estimate. A completely random, irrelevant number, their phone number, shaped their professional guess. So now think about what happens when an analyst gives you a very specific price target on a stock. It just anchors you. All right, so forecasting is basically a train wreck, and it's propped up by our own weird brain biases. So what are we supposed to do? Just give up? No! The good news is there is a much smarter, much more effective way to approach investing. And it all starts with a huge mindset shift. We need to stop predicting and start preparing.
Ben Graham, the guy who literally wrote the book on value investing, put it perfectly. He said, our job is to do analysis, not to be prophets. The goal should be to understand a business inside and out, right now, in the present. What is it actually worth today? That's a solvable question. Guessing what it will be worth in the future, that's a fool's game.
So let's just lay it out, side by side. Prediction is all about guessing the future. It relies on things we can't possibly know, it makes us overconfident, and it builds a fragile portfolio. Preparation, on the other hand, that's about understanding the present. It's based on real evidence you can see today, it forces you to think about a whole range of things that could happen, and that builds resilience. It's a completely different game. So what does this actually look like? Well, here's a super powerful technique. You take that flawed, discounted cash flow model we talked about, and you flip it completely on its head. Instead of forecasting growth to get a price, you start with today's stock price. Then, you work backward to figure out what kind of growth the market is expecting to justify that price. And then, you just ask a simple, powerful question. Is that expectation realistic? Is it even possible based on history? It changes the question from what will happen to, are the market's bets crazy right now? The legendary investor Howard Marks lives by this idea. It's his whole philosophy. You can't predict, but you absolutely can prepare. He accepts that the future is a mystery, but he also knows that by understanding where we are right now, are things expensive, are people greedy or fearful, we can position ourselves to handle whatever the future decides to throw at us. Okay, let's bring it all home. What's the one big idea you should walk away with after all of this? It really is a complete shift in how you think about knowledge when it comes to investing.
This is another gem from Ben Graham, and it's just a brilliant way to think about it. You don't need to know a person's exact weight down to the ounce to know if they're overweight. You can just look at them and get a pretty good idea. It's the same in markets. You don't need a precise forecast. You just need a general sense of things. Are we in a cheap market or an expensive one? A greedy one or a fearful one? That approximate sense of today is worth so much more than a precise but totally wrong guess about tomorrow.
And that leads us right to this perfect quote from the economist John Maynard Keynes. This should be printed out and taped to every investor's computer screen. I'd prefer to be approximately right rather than precisely wrong. Just let that sink in. Give up the search for that false perfect answer. Embrace the power of being generally right. It's more humble, sure, but it's also way more effective. So I'll leave you with this one question to think about. Take a hard look at how you make your own financial decisions, your reasons for buying something, or for selling it. Are those reasons based on trying to predict what's going to happen next week, next month, next year? Or are they based on deep preparation and an understanding of what's happening right now? The answer to that question? Well, it could change everything.
You know, when you're facing a big decision, especially with something like investing, we're always told the same thing. Information is power. The more you know, the better your choice will be. I mean, that's just common sense, right? But what if that's not just wrong, but actually gets in the way of your success?
The historian Daniel Boorstin absolutely nailed it with this quote. It points to a really dangerous trap. It's like we're addicted to information, constantly digging for one more piece of data. But all that hunting can create this powerful illusion, making us feel smarter without actually helping us make better calls. All right, so how do we get out of this trap? In this explainer, we're going to break it all down. First, we'll expose what I call the information illusion. Then we'll look at the bizarre gap between our confidence and our actual accuracy. We'll see why less is very often more, and then dive into a life-or-death case study that shows how to find that crucial signal in all the noise. Finally, we'll see the power of simplicity in action and figure out how you can start building your own focused framework. Okay, let's dive right in and put that so-called obvious truth, that more info is always better, right under the microscope. So this is the big question, right? It's exactly what researchers have been studying for years. We'd think that if extra information is useless, our brain would just, ignore it. But it turns out that's not what happens at all. Not only do we not ignore it, it actually just ends up confusing us. So to really see this in action, let's look at a couple of fascinating studies. They put experts up against a growing pile of data, and the results? Well, they reveal a really surprising and incredibly consistent pattern. In this first one, researchers took 8 seasoned bookmakers and had them predict horse races. They gave them info in chunks,
First 5 data points, then 10, then 20, all the way up to 40. And what they found was just wild. The bookies' accuracy at picking the winners completely flatlined. They were just as good with 5 pieces of info as they were with 40. But their confidence shot up, from a pretty shaky 17% to over 30%. All that extra data didn't make them any better, it just made them feel a whole lot better about their bad picks.
And this right here is the key takeaway, the pattern you're going to see over and over again. As we get more information, our confidence just skyrockets, but our actual ability to make the right call, it pretty much goes nowhere.
Now check this out. Another study on predicting college football games found the exact same thing, but with a really cool twist. They had a computer model analyze the same data as the human experts. For the computer, more info is actually better. Its accuracy climbed from 56% all the way to 71%. But the humans, you guessed it, just like the bookmakers, their accuracy was stuck in neutral, whether they had 6 or 30 facts. And their confidence? It blasted off, from 69% to almost 80%.
Okay, so you've got to be asking, why? Why do computers get better with more data, while we humans just get more overconfident? The answer, it turns out, is baked right into the hardware of our brains.
Think about it. We're not supercomputers, right? We have a very real, very limited processing capacity. We can only consciously juggle a few variables at a time. So when we try to process too much stuff, we don't get smarter. We just get overloaded, and the quality of our decisions actually starts to tank.
Here's a perfect everyday example from a study where people had to pick the best of 4 cars. When they only had 4 key attributes to compare, like gas mileage and safety, nearly 60% picked the best car. But when they were given 12 attributes for each car, total information overload, only about 20% made the right choice. More information literally led to worse decisions.
Okay, so we get the problem. Information overload is bad. But what's the solution? Well, this next case study is incredible. It comes from a hospital ER, a real life-or-death situation, and it shows us exactly how to separate that critical signal from all the distracting noise.
All right, picture this, a busy ICU in a Michigan hospital. It's overflowing. Doctors are sending pretty much every patient with severe chest pains, about 90% of them, straight to the ICU. But here's the kicker. Their decisions were no better than a coin flip. They were getting bogged down by what researchers called pseudo-diagnostic information. You know, stuff that feels really important, like family history, age, smoking habits, but in that critical moment, it's not actually the best predictor. It's just noise that sounds like a signal.
So, what did the researchers do? They came up with something so simple it's brilliant. They created a basic checklist, just a few yes or no questions. It forced the doctors to ignore all that distracting noise and focus only on the handful of things that were truly diagnostic, like a specific reading on the EKG. It made the decision crystal clear.
And the results? Absolutely incredible. After they started using this simple checklist, they slashed the number of people wrongly sent to the ICU by half. And get this, the number of patients who did need to be there and were correctly admitted actually went up. It was a massive win, all by focusing on less.
And look, this isn't just some one-off thing for doctors. The power of simplifying these huge, complex decisions by just zeroing in on what really matters, well, that's a universal principle that works almost everywhere.
I mean, it's not an isolated case at all. Look what happened when a simple 19-point surgical checklist was introduced in operating rooms. We're talking basic stuff, confirming the patient's name, counting the sponges. The results were just as astounding. The patient death rate was cut by more than half, and complications after surgery dropped from 11% to 7%. Simple frameworks, it turns out, literally save lives.
So, let's bring this all back to us. What does this mean for you as an investor, or really for anyone making a big decision? The lesson couldn't be clearer. You are far, far better off focusing on what truly matters than drowning in the endless sea of noise that Wall Street pumps out every single day. You know, the legendary investor Jean-Marie Eveillard, he just nailed it. He said his main job wasn't to know everything about everything. It was to figure out the 3, 4, or 5 things about a business that really matter. That's it. And hey, who are we to argue with Warren Buffett, right? You never hear him talking about the latest market chatter. His method, in his own words, is very simple. He just looks for a few core things: a great business, honest managers, and a fair price. That is his signal.
So the big takeaway here is that you need to build your own simple framework. For example, the author of our source material is a deep value investor, and he has a simple 3-point checklist. Number 1, is it cheap? Number 2, is the company going to go broke? And number 3, what's management doing with the money? That's his whole framework. It lets him cut through all the noise.
And that really brings us to the final, most important question, the one for you. The next time you're facing a big choice, in your portfolio, at work, in your life, just stop. Resist that urge to go find one more article, one more data point. Instead, ask yourself, what are the 3 to 5 things that truly matter here? Finding that signal, it's not just a nice idea. It is the absolute secret to making smarter, sharper, and way more successful decisions.
So, have you ever noticed how our brains can get tricked by things that sound good but are actually completely meaningless? Today, we're going to dig into that. We're going to start with a really weird question at a photocopier, and by the end, you'll see why most of the financial news you watch on TV is basically just noise. It's going to be a fun one. Let's get to it. Okay, picture this. You're in a long line waiting to use a photocopier. Someone walks right up to the front and asks this exact question. They want to cut. So, would you let them? I mean, think about that reason for a second. Because I have to make copies. Yeah, that's why everyone's in the line. It sounds totally ridiculous, but this silly little question was actually the key to a really fascinating psychology experiment. All right, so here's how the experiment worked. It was pretty clever. The researchers had a person try to cut in line using 3 different excuses. First, they just asked, straight up, no reason given. For the second group, they gave a real solid reason, because I'm in a rush. Makes sense, right? And for the third, they used that bizarre, totally pointless reason we just heard, because I have to make copies. Now, this is where it gets absolutely wild. Look at these results. With no reason at all, about 60% of people said, sure, go ahead, okay? When they gave a real reason, being in a rush, compliance shot up to 94%. But here is the absolute shocker. When they gave that useless, garbage reason, 93% of people still said yes. The only thing that mattered was the word because. Our brains just hear that structure and poof, they switch off and accept it. And you know, this autopilot mode isn't just for cutting in line. The same researchers wondered if this would work in, say, an office. So to test it, they did something kind of hilarious. They literally went dumpster diving through a university's trash to find old office memos so they could create a fake one that looked perfectly legit. And here's the proof in the pudding. They sent out this very official-looking, but totally impersonal memo. All it asked the secretaries to do was to immediately return the piece of paper they were holding to a different room. A completely pointless task, right? Well, a staggering 90% of them just did it. No questions asked. Why? Because it looked right. It had the right format, so their brains just went on autopilot. This mental shortcut doesn't just make us do silly tasks. It can actually go way deeper and shape what we believe to be true. A few years back, the Catholic Church got so worried about the wild popularity of the novel The Da Vinci Code that it actually paid for a poll to see how the book was affecting what its readers believed. And the results were just stunning. People who had read this piece of fiction were twice as likely to believe one of its biggest and totally unproven claims. And they were 4 times as likely to believe a really negative portrayal of a real-life religious group. The story just felt plausible, it was presented in a convincing way, and for so many people, that was enough to make fiction feel like fact. So all this stuff we've been looking at, it actually has a name. It's called placebic information. Think of it like a sugar pill. It looks like medicine, but there's nothing inside. It's information that sounds like it has real substance, but it's just filler, using trigger words like because or a familiar format to trick our brains into nodding along. It's the ultimate because I have to make copies of the world. Okay, so where do we see this on a gigantic scale every single day? You guessed it, the world of finance. This quote just nails the feeling of what some people call bubble vision. You know, the constant chatter on financial news channels. Every tiny wiggle in the market gets a confident-sounding explanation. But are those explanations real? Or are they just placebic? And that leads us to the big flashing question mark. When you see a headline that says, "Market dropped today because of job numbers," is that the actual reason? Or are we all just standing in the photocopier line again, being soothed by an explanation that just sounds right, even if it's totally meaningless? Is there a huge disconnect between the news we hear and what's actually going on? Well, to figure that out, we can't just guess. We need to look at the data. Economist Larry Summers was part of a major study that did exactly that. His team found the 50 biggest one-day price swings in the U.S. stock market over a 40-year period. Then they basically became historians, digging through old newspapers to find the official reason the media gave for each of those monster moves. And the conclusion they reached was, well, it was a total bombshell for the world of financial news. For more than half of the biggest, most dramatic days in the market, the press had no convincing explanation for why it happened. No big news, no clear fundamental reason. The reasons we hear every day are very often just stories, made up after the fact to fill the silence. So if listening to the daily news is just asking to be misled, how in the world are we supposed to think about the market's crazy ups and downs? Well, luckily for us, the investing legend Ben Graham gave us a much, much better way to think about it. He told us to imagine the market as a person, our business partner, a guy named Mr. Market. Okay, so here's how this partnership works. Your partner, Mr. Market, is, well, he's manic depressive. He's incredibly emotional. Some days he's euphoric, totally giddy, and he offers to buy your shares from you at ridiculously high prices. Then on other days, he's terrified, panicked, and offers to sell you everything he owns for pennies. Your job as the sane, rational investor is to just ignore his moods and decide for yourself if his offer is a fantastic bargain or just plain silly. This quote from Graham just says it all, doesn't it? The daily price of the market isn't some final judgment on what your investments are worth. No way. It's just an emotional offer from your very moody business partner. You have absolutely no obligation to listen to him, let alone trade with him. You can just ignore him completely until he calms down and makes you a sensible offer. And once you start thinking this way, everything changes. All that volatility, those wild swings that scare everyone else, they're not a problem to be avoided. They're not a bug in the system. They're a feature. Mr. Market's emotional breakdowns are the very thing that creates incredible opportunities for the rest of us. Without his panic, there'd be no bargains to find. The famous economist John Maynard Keynes understood this paradox perfectly. He basically said that the very same market swings that create amazing bargain prices are also what creates the fear and uncertainty that stops most people from buying them. So if you can keep your head while Mr. Market is losing his, you have a massive advantage. Okay, so this all sounds good in theory, right? But how do you actually put it into practice? How do we protect ourselves from the constant hum of bubble vision and the emotional pull of our crazy partner, Mr. Market? Well, some people take some pretty extreme but very effective steps. Get this, there's a story about an investment firm that believes this daily noise is so toxic to good decision-making that they have only one Bloomberg terminal, that fire hose of financial data and news, in the entire office. And get this, if anyone is caught actually looking at it, they are subjected to ritual humiliation from their coworkers. They have literally made ignoring the noise part of their company culture. It's brilliant. And really, that's what it all comes down to, isn't it? Mr. Market never, ever shuts up. He is yelling prices, he's yelling fears, he's yelling so-called reasons at you every single day. The real question isn't what he's saying. The real question is whether you have the discipline, the mental strength to just ignore him when he's being crazy. Are you strong enough to turn off the bubble vision? All right, welcome to The Explainer. Today, we're going to dig into a powerful mental trap that quietly shapes our decisions every single day. It's a cognitive bias that gets all of us, even the smartest people out there, and we're going to break down how you can spot it and, more importantly, how you can fight it. Okay, so to kick things off, let's start with a little brain teaser. Now, this thing looks super simple at first glance, but it has a shockingly high failure rate, and it perfectly sets the stage for what we're about to uncover. Okay, so here's the setup. You've got 4 cards in front of you, E, 4, K, and 7. And the rule is pretty straightforward. If a card has an E, it must have a 4 on the other side. Now, you only get to flip over 2 cards to prove whether this rule is true or false. Which 2 are you picking? Go ahead, you can even pause here if you want to really think it through, because trust me, it's a lot trickier than it looks. So, if you found that a little tough, you are in very, very good company. I mean, get this, a staggering 95% of professional fund managers get this wrong. We're talking about people whose entire job is making sharp, logical calls with big money on the line, and still, this bias trips them up. So what do most people pick? Yeah, it's almost always the E and the 4. Now, flipping the E makes total sense, right? If you turn it over and there's, say, a 7 on the back, the rule is instantly broken. But flipping the 4, that's the trap. See, the rule says an E must have a 4. But here's the catch. The rule never said anything about what has to be on the other side of a 4. It could be a K, it could be a Z, it doesn't matter. So flipping that 4 is actually a waste of a turn. It tells you nothing. Okay, so the right answer, it's the E and the 7. We know why we need to flip the E, but the 7, now that's the sneaky one. Why the 7? Because if you flip that card over and there's an E staring back at you, boom, the rule is instantly broken. You found a card with an E that does not have a 4. And that's the whole point, right? The secret isn't just looking for proof that you're right. It's about actively, aggressively trying to prove yourself wrong. You see, that little card trick, it's a perfect window into this massive glitch in our thinking. That's often called the confirmation trap, or more famously, confirmation bias. It's our built-in desire to find stuff that agrees with us. So here's the textbook definition, but let's break it down. We are basically hardwired to look for, listen to, and remember information that fits nicely with what we already think. It's like living in an echo chamber. We love hearing our own ideas bounce back at us. It feels great. It feels cozy, but it's a terrible way to find out if you're actually, correct. Check this out. Here's another great example. Imagine I show you the numbers 2, 4, 6 and tell you they follow a specific rule. Most people immediately think, the rule is even numbers going up by 2. So what do they test? They test sequences like 8, 10, 12, or 20, 22, 24. They're looking for confirmation, but the actual rule is just any numbers in ascending order. The quickest path to the real rule is to test something that would smash your theory to pieces, like 1, 2, 3, or even 3, 2, 1. You got to try to falsify your own idea. And this idea goes against everything the legendary philosopher of science, Karl Popper, talked about. For him, real science wasn't about finding evidence to support a theory. No. It was about trying with all your might to disprove it. If you throw everything you've got at an idea and it still stands, well, then you might really be onto something. And believe me, this isn't just some dusty old philosophical idea. Charles Darwin was a master of this in practice. He was keenly aware of how easily our brains forget inconvenient facts. So whenever he stumbled upon a piece of data that seemed to go against his theory of evolution, he would literally stop everything and write it down on the spot, because he knew his own brain would try to forget it, to sweep it under the rug. Now that is some serious intellectual discipline. Okay, so that's the theory. But what happens when this bias runs completely amok in the real world? Well, let me tell you the bizarre and tragic story of Sir Roger Tichborne. So, picture this. It's the 1860s. Lady Tichborne's son, Sir Roger, has been presumed lost at sea for years, but she refuses to believe it. She just can't accept it. And then, out of the blue, a man from Australia claims to be him. For her, this was it, the miracle she'd been waiting for. But, yeah, there was a problem. A big one. Just look at the facts here. The real Sir Roger was a slim man. This guy was obese. Sir Roger had blue eyes. Nope, this guy's were brown. The real Roger had some very distinctive tattoos. This guy, clean slate. And maybe the real kicker? Sir Roger grew up in France and spoke perfect French. The imposter couldn't speak a single word. So you'd think that's case closed, right? Not even close. For Lady Tichborne, none of that mattered. Not a single bit of it. Her belief that her son had returned was so powerful, it acted like a filter, blocking out every single contradictory fact. She saw what she wanted to see, accepted him, and that was that. It was only after she died that he was finally exposed as a total fraud. Now that story is pretty wild, a real outlier, you might think. But here's the scary part. Modern studies show that we all do this, just maybe on a smaller scale. We are all, in some way, prisoners of what we already think. In one famous study, they took people who are for the death penalty and people who were against it, and they showed both groups 2 well-researched studies, one for it, one against it. Now, you'd think that seeing conflicting evidence would make people, maybe a little less certain, right? Maybe meet in the middle? Nope. The exact opposite happened. Both groups thought the study that agreed with them was brilliant, and the one that disagreed was junk. They've dug in their heels even harder. The new information actually made them more polarized. How crazy is that? Okay, here's another one that'll blow your mind. In a different study, researchers could predict whether someone thought there was enough evidence in a legal case to issue a subpoena with 84% accuracy just by knowing their political leanings. They didn't even need to know the actual facts of the case. But wait, it gets crazier. This is the part that really illustrates the point. So what happened when they finally added all the actual evidence from the case into their prediction model? How much more accurate did they get? It jumped by 1%. A single percent, from 84 to 85. I mean, just let that sink in for a second. What that's really telling us is stunning and, frankly, a little scary. Once we've made up our minds about something, the actual evidence, well, it barely even matters. It's just noise. The more sure we are, the better we get at twisting any new information to fit what we already believe. Okay, so if this bias is so baked into our brains, are we just doomed? Is there a way to fight back? Well, yes, and for a really powerful strategy, we're going to look at the world of high-stakes investing, where being wrong can cost you millions. This quote from a very successful investor, Bruce Berkowitz, just nails it. Instead of falling in love with an idea and looking for all the reasons it's going to be a home run, he and his team do the exact opposite. They become its biggest enemy. They go on a mission to absolutely obliterate their own best ideas. And this isn't just some vague philosophy for him. He's built a system for it. It's called a pre-mortem. He basically fast-forwards 6 months and pretends the investment was a total disaster. Then he asks, okay, what killed it? And he goes down a checklist. How do companies usually die? Well, they burn through all their cash. They take on way too much debt. They have clueless management. They start buying up businesses they know nothing about, or they just plain lie on their financial statements. By systematically attacking his ideas this way, he's built a firewall against his own biases. And that really brings it all back to us, doesn't it? So I'll leave you with this question to think about. What's one big idea, one core belief you have that you've never really tried to break, that you've only ever looked for reasons to support? Because when you start intentionally looking for the ways you might be wrong, instead of just the ways you're right, well, that's when you really start to learn something. That's when you find the real upside. All right, let's dive into something we all see, especially in the world of finance and investing. People who have an opinion and just will not let it go. Today, we're taking a trip to a land of unshakable beliefs, and we're going to meet some characters who show us just how hard it is to admit when we're wrong. So to kick things off, let's start with a little puzzle. Imagine you've got 2 big jars of poker chips. The first one is mostly red, 70% red, 30% blue. The second one is the opposite, mostly blue. Now we pick one of those jars at random and we pull out 12 chips. We get 8 red and 4 blue. So here's the question for you. What do you think the odds are that we picked from that mostly red jar? Just go with your gut. Most people guess somewhere around 70, maybe 80%. What's your number? You ready for this? The actual answer is a whopping 97%. Yeah, 97. If your jaw just dropped a little, you are definitely not alone. Our brains, our intuition, just aren't very good at calculating the real power of new evidence. In this case, just how significant those 8 red chips really are. And this little mental glitch, it's a fantastic window into a huge bias we all have. So what's going on here? Well, this puzzle is a perfect example of something called conservatism bias. It's really just a fancy way of saying that our brains tend to cling to what we already believe. When we're hit with new facts, we don't update our opinions nearly as much as we should. It's like we're anchored to our first idea and we only move away from it kicking and screaming. Okay, but this isn't just some quirky math problem, right? This bias has massive, and I mean massive consequences out in the real world, especially in the high-stakes game of finance, where it basically creates entire personality types. And this is where we meet the perma-bull and the perma-bear. You've probably seen them. A perma-bull thinks the market is always going to the moon, no matter what. And a perma-bear, they're always convinced a crash is right around the corner. As the investor Doug Cass puts it so well, their real talent is being stubborn. Once they form a view, that's it. It makes them great for getting on TV, but maybe not so great at actually managing money. And you don't have to take my word for it. Just look at this chart. This is fascinating. The gray line shows what companies actually earned. The black line is what all the smart Wall Street analysts predicted they would earn. See a pattern? That black line is always playing catch-up. It never leads reality. It just slowly, reluctantly follows it. It's the definition of driving by looking in the rearview mirror. So the huge takeaway here is that even the experts, the people who get paid the big bucks to predict the future, are completely susceptible to this bias. They get anchored to their old forecasts, and they only change them after the world has already moved on. And even then, they adjust way, way too slowly. And the stories from the trenches are, well, they're pretty wild. The author of our source material talks about getting actual hate mail from his perma-bear clients when he turned optimistic in 2009. He describes his old investment team having meetings where the whole point was to come up with reasons why their wrong views were about to become right. And who could forget this gem from 2008? Companies putting out press releases claiming that a global financial meltdown would somehow be good for their business. It's incredible. This all seems so irrational, right? So to really understand why we're all so stubborn, we have to look under the hood at the psychology behind it all. And a classic experiment gives us a really fascinating clue. So in this famous study, a group of psychologists were asked to create a personality profile for a man named Joseph Kidd. But they were fed information about him in stages. First, just the basics. Then some details about his childhood. After that, his high school and college years. And finally, his time in the army and later life. And after each piece of new info, they had to update their assessment of him.
And here is the absolutely jaw-dropping result. As the psychologists got more and more information, their accuracy in diagnosing him barely budged at all. A measly 3% improvement from start to finish. But their confidence that they were right, it went through the roof. It jumped by 20%. So think about that. More information didn't make them more right. It just made them more certain that they were right from the beginning. The key here, the really crucial insight, is that the psychologists pretty much formed their opinion based on that first little bit of information. And after that, every new fact wasn't used to challenge their diagnosis. It was just used to confirm it. In fact, the more they learned, the less likely they were to change their mind. Their first impression was basically set in stone. This deep-seated refusal to change our minds, even when new facts are staring us in the face, points to an even deeper psychological trap. The root of all this stubbornness, it often has less to do with the evidence right in front of us and everything to do with the baggage we're carrying from the past. Okay, check this out. Look at these two scenarios about building a stealth plane. In the first one, you've already spent $10 million on a project, but now a competitor's plane is clearly better. Do you spend the last million to finish yours? Over 80% of people say yes. Now, scenario 2, you have $1 million to invest. Do you put it into that same, now inferior project? Over 80% say absolutely not. It's the same project, but the decision completely flips. Why? That powerful force is the sunk cost fallacy. It's our tendency to keep doing something, not because it's a good idea now, but because we've already poured time, money, or effort into it. That investment is gone. It's sunk, but we just can't let it go. It's the reason you finish a terrible movie you're 2 hours into. And this deep need to justify our past choices, it's a huge driver of the conservatism bias we've been talking about. So, the big question is, if we're all wired this way, what on earth can we do about it? How do we escape the trap of our own stubborn minds? Well, the good news is there are actually some really concrete strategies you can use to force yourself to think more clearly. Let's run through a few powerful tools. First, the blank slate approach. You pretend your entire investment portfolio was just liquidated into cash. It's zero. Now, knowing what you know today, would you go out and buy the exact same stocks? If the answer is no, you know what you have to do. Second, get a fresh pair of eyes from someone who isn't already anchored to your decision. And third, and this is a great one, find a devil's advocate. Literally assign someone the job of arguing against you. But to really truly appreciate the kind of intense discipline it takes to fight this bias, you have to hear about the radical solution used by one of the greatest investors of all time. Get this, Michael Steinhardt would, from time to time, do the unthinkable. He'd call his broker and just sell everything. His winners, his losers, the long positions, the short positions, all of it. Why would he do that? To force himself to start over with a truly, completely clean slate, totally free from the psychological weight of all his past decisions. It's an extreme move, but it shows you how powerful this bias is. And that really brings us to the fundamental question that this entire explainer has been building towards. It's a question you should be asking yourself constantly about your investments, about your career, about your deepest beliefs. When you are confronted with new, undeniable facts, what do? The great economist John Maynard Keynes absolutely nailed it with this quote. Being smart isn't about being right all the time. Real intelligence is having the humility and, frankly, the courage to change your mind when the world shows you you're wrong. So I'll just leave you with his question to think about. When the facts change, what do you do?
You know, we humans are basically story-making machines. It's how we make sense of everything, right? It's how we connect, how we remember. But what if that greatest strength, our love for a good story, is also one of our biggest weaknesses, especially when the stakes are high? Well, today, we're diving deep into the powerful and often dangerous siren song of stories.
And to kick things off, let's look at this quote from Nassim Nicholas Taleb. He's the guy who wrote The Black Swan. He coined a term for this weakness, the narrative fallacy. And what he's really saying here is that our brains are just wired to choose a neat, tidy story over a messy pile of facts every single time. It's like a glitch in our operating system, and it can have absolutely massive consequences.
So here's our game plan. First, we're going to really unpack what the narrative fallacy is. Then we'll see it in action everywhere, from the courtroom to the doctor's office. We'll look at how a story can literally change what we think something is worth, how it can totally blindside us as investors, and most importantly, what you can actually do to fight back against it.
All right, first up, the narrative fallacy. And it's so important to get this. This isn't some minor little quirk we have. Nope, this is a fundamental part of how our brains work, a mental shortcut that, more often than not, leads us way off course.
So what does this really mean? Well, the bottom line is this. When our brain is faced with a choice between a really compelling story and a bunch of cold, hard evidence, we almost always pick the story. We will literally throw the facts out the window. And this isn't just about entertainment. It fundamentally twists our picture of reality, making us feel super confident about choices that the data is screaming are just plain wrong. Now let's put this to the test. It's time for a head-to-head battle. Stories versus statistics. This is all about that epic tug-of-war between a powerful emotional anecdote and a spreadsheet full of data. You'd think in any serious situation, the data would win, right? Well, you're about to be very surprised. To see just how deep this goes, I want you to imagine you're in the jury box for a first-degree murder trial. I mean, the stakes don't get any higher than this. Now, do you think it should matter how the lawyers present the exact same set of facts? Logically, absolutely not. A fact is a fact. But that's just not how our brains are built. Okay, now get ready for this, because the results of a study that tested this are just wild. When jurors were just given the facts, one witness at a time, no narrative, 63% voted guilty. Think of that as our baseline. But look what happens when you weave those exact same facts into a story. When the prosecution tells a compelling story, the guilty verdict shoots up to 78%. And when the defense tells a story, it plummets to just 31%. That's almost a 50-point swing based on absolutely nothing but storytelling. Insane.
And if that's not scary enough, this isn't just happening in courtrooms. This exact same mental glitch pops up when we're making choices about our own health, decisions that are quite literally life or death.
Just look at this table. The results are staggering. Top line, you've got a treatment that's 90% effective. Statistically, that's a home run. You pair it with a positive patient story, and 88% of people choose it. Makes sense. But now, look what happens when you pair that same 90% effective treatment with just one negative story. The number of people who choose it craters to 39%. They completely ignore the stats. And it gets worse. Look at that third row. A treatment that only works 30% of the time, terrible odds, is chosen by a whopping 78% of people, all because it was paired with one good anecdote.
Okay, so we've seen stories can sway justice and our health. But what about something as simple as value? It turns out even a number, like a price tag, tells a powerful story that can literally change our physical experience of a product.
Check out this fascinating experiment. Researchers gave people a placebo, a simple sugar pill for pain. Half the group was told it cost $2.50 a dose. The other half was told it was on sale for just 10 cents. The pill was identical, but the results? Night and day. An incredible 85% of the people who took the expensive pill said their pain went away, compared to only 61% for the cheap one. The story, that expensive means it's better, was so powerful it actually made the placebo work better.
And hey, this isn't some weird one-off thing. It happens with wine, too. In one study, people were given the exact same wine in 2 different glasses. They were just told one was a $10 bottle and the other was a $90 bottle. The result? You guessed it. They consistently said the $90 wine tasted almost twice as good. The story told by the price tag literally rewired their sense of taste.
So, if a story can change our physical experience of pain and taste, what in the world do you think it does in the stock market? A place that is almost entirely driven by stories about the future.
Let's look at how we end up investing in narratives instead of numbers. So let's split the market into two teams. On team one, you have the admired stocks. These are the companies everyone loves, right? They've got amazing stories, the press loves them, strong growth. On team two, you have the despised stocks. The story is terrible. They're in a boring industry, performance has been weak, and nobody's excited about them. Now, just going on gut feeling, which team sounds like the smarter investment?
And here is the big twist. The research is crystal clear on this. The despised stocks, the ones with the awful stories that nobody wants to touch, they are usually a far better investment. They significantly outperform the market darlings. So why? It's because the amazing story of the admired stocks is already baked into the price, and then some. Everyone expects greatness, so there's no room for good surprises, only disappointment. But for the despised stocks, expectations are so low that even a tiny piece of good news can send the stock soaring.
Okay, let's zoom in on one of the most story-driven and, frankly, most dangerous corners of the market: initial public offerings, or IPOs. This is where the narrative fallacy costs investors a fortune, because with an IPO, you are basically paying for one thing and one thing only: a story about the future. IPOs are pretty much the ultimate narrative trap. They hit the market with these fantastic, exciting stories. You know, the sexy new online gaming company. This creates a massive hype machine. One gaming IPO, for example, was 14 times oversubscribed. But the reality after the hype dies down? It's grim. On average, IPOs underperform the rest of the market by a shocking 21% per year for the first 3 years. And here's the real kicker: the total disconnect between story and reality. One study found that the prices investors paid meant they were expecting 33% growth every year. And what did those companies actually deliver? Negative 55% growth. Investors paid for a rocket ship and got a rock. And this chart right here is the perfect picture of how these stories infect even the pros. Take a look. This shows earnings for the global mining industry. You see decades of normal, predictable cycles, and then this gigantic spike between 2003 and 2008. The story everyone was telling was the China supercycle, this idea that demand would grow to the moon forever. So what did the professional analysts do? Did they predict things would go back to normal? Of course not. They fell for the story, hook, line, and sinker. They drew that straight black line you see, forecasting that this insane growth would just keep going. They completely ignored history, and investors who followed that story got absolutely crushed. Okay. We have seen just how powerful and how dangerous this siren song of stories can be. It can sway a jury, mess with your medical choices, and completely wreck your portfolio. So the big question is, what can we possibly do to defend ourselves against a bias that's so deeply wired into us? Well, the answer is actually pretty simple, even if it's not always easy.
The legendary investor Ben Graham, the godfather of value investing, gave us the answer almost 100 years ago. He basically said that true safety in investing, and I'd argue in life, has to be built on a foundation of facts, data, and objective standards. It can't be based on market hype or stories that are twisted by what he called psychological excesses. That wisdom is as true today as it ever was.
So, here's your mental toolkit, your defense plan. Step 1. Just admit you have the bias. You have to know that you are hardwired to fall for a good story. We all are. Step 2. Actively question the narrative. When you hear a story that sounds amazing, force your brain to ask, okay, that sounds great, but what if the exact opposite is true? Step 3. Intentionally prioritize the data. Hunt for the numbers, the statistics, the boring stuff. And finally, step 4. Like the old TV show Dragnet used to say, just the facts. Strip away all the emotion and the drama and just look at what is actually there.
So I'll leave you with this. Stories are beautiful. They're essential for being human. But they are a terrible, terrible tool for making high-stakes decisions. The next time you're faced with a narrative that feels exciting, that feels compelling, that just feels too good to be true, are you going to let yourself get pulled in by that siren song? Or are you going to have the discipline to stop, to challenge that story, and to listen to what the numbers are really telling you? That choice is all yours.
This time is different. You've heard that phrase before, right? Well, in the world of investing, it's been called the 4 most dangerous words in the English language. It's the siren song of pretty much every financial bubble, from the tulip mania of the 1600s all the way to the dot-com bust. But what if understanding why we keep falling for it is actually your biggest advantage? Okay, let's dive into this.
So here's our game plan for this explainer. First, we're going to shatter the myth that bubbles are just these random acts of nature. Then, we'll get into the 5 psychological traps that catch even the smartest investors off guard. After that, we'll give you a 5-phase model so you can actually spot these things in the wild. And then, and this is the best part, we'll reveal your secret weapon, your advantage over the pros. Finally, we'll wrap it all up with the one big idea you absolutely need to remember.
All right, let's get right to it. The common wisdom, even from former Fed chairs, is that bubbles are black swans, these totally unpredictable, out-of-the-blue events. But you know what? The data tells a very, very different story. A story that might just change the way you look at the market forever.
So you have this idea of a black swan, right? It's unpredictable, has a massive impact, and we only really understand it after the fact. It's kind of convenient because it lets everyone off the hook. Nobody could have seen it coming. But a much better way to think about bubbles is as a predictable surprise. In this case, the problem is actually known. It just gets worse and worse over time until it finally explodes into a crisis that shocks everyone, even though all the warning signs were right there.
So let's do a little thought experiment here. If you buy into standard financial theory, the whole efficient markets hypothesis thing, it says that asset prices reflect all the available information. So, a huge market event, a bubble so extreme, well, how often do you think something like that should happen?
Well, according to the math behind all that theory, you should only see an event of this size about once every 44 years. Think about that. It's a once-in-a-generation kind of thing. It's supposed to be incredibly rare and shocking. But is that what we actually see in the real world? Not even close. The reality is, frankly, stunning. Researchers at the investment firm GMO actually went back and looked for these massive market events since 1925, and they didn't find one every 44 years. They found over 30 of them. That works out to a major bubble forming just about every 3 years. And here's the absolute kicker. It's not just that these bubbles formed with shocking regularity. It's that every single one of them, without exception, eventually burst. They all came crashing back down. For this to happen over 30 times when the theory says it should be a once-in-a-lifetime event, well, that's the giant elephant in the room for anyone who thinks markets are perfectly rational.
So this raises a huge question, right? If these bubbles are so common and they follow such a clear pattern, why do we keep falling for them over and over again? Well, the answer isn't in our spreadsheets, it's in our heads.
See, there are at least 5 major psychological hurdles that basically act like a blindfold, stopping us from seeing what's right there in front of our faces. And these are powerful. They're hardwired into us, affecting everyone from the newest investor to the most seasoned pro on Wall Street. Let's break them down.
First up, our old buddy, over-optimism. You know this one. It's that little voice in our head that says, yeah, but it won't happen to me. We all tend to think we're less likely than the average person to get divorced or get into a car accident. And that same sunny disposition makes us totally blind to the real dangers of a bubble that's inflating right under our noses.
Next up is the illusion of control. This is where all the financial pseudoscience comes into play. These super complex models that claim to measure and manage risk, giving everyone this false sense of security. It's kind of like buying a car with an airbag that's guaranteed to work perfectly unless you get in a crash. Just having a number on a page makes us feel safer, even if that number is totally useless when things really go sideways.
Okay, this third one is a real heavyweight, self-serving bias. This is our deep, deep desire to see the world in a way that just happens to benefit us. When everybody is making a ton of money in a bubble, it becomes almost impossible for them to step back and say, hey, wait a minute, does this actually make any sense?
Warren Buffett absolutely nailed it with this one. Think about it. If a barber's entire income depends on cutting hair, he's always going to find a reason you need a trim. It's the exact same thing in finance. If your bonus depends on the bubble getting bigger, you'll find every reason in the world to believe it will.
And if you want a perfect example, Exhibit A has to be from the dot-com bubble. There was this analyst, Henry Blodgett, who was publicly telling everyone that a certain stock was a great buy. But what was he saying in his private emails? He called that exact same stock such a piece of crap. The self-serving bias was just too powerful to resist.
Hurdle number 4 is myopia, or just being extremely short-sighted. Look, we are hardwired to care way more about today's rewards than tomorrow's risks. It's that whole eat, drink, and be merry vibe. In finance, it sounds something like, just one more good year, just one more big bonus, and then I'll get responsible. As St. Augustine famously prayed, Lord, make me chaste, but not yet.
And the last barrier is called inattentional blindness. You might have heard of that famous experiment where people have to count basketball passes in a video. While they're laser-focused on counting, a person in a full-on gorilla suit walks right through the middle of the game.
And guess what? More than half the people don't see the gorilla at all. In finance, we get so bogged down in the daily noise, the quarterly reports, the market chatter, that we completely miss the giant gorilla in the room, the unsustainable bubble staring us right in the face.
So we know bubbles are common, and we know our own brains are basically working against us. So what in the world can we do? Well, we can arm ourselves with the one thing that cuts through the noise: history. Let's look at a practical framework that has described pretty much every bubble we've ever seen. And check out this quote from the brilliant philosopher and economist John Stuart Mill. He wrote this all the way back in the 1800s, and it just gets right to the heart of it. Bubbles are not fundamentally a problem with money or markets. They are a problem of human psychology, of the mind.
And Mill didn't just diagnose the problem. He gave us this simple but incredibly powerful 5-phase model to understand the entire life cycle of a bubble. Seriously, economists have been using this same framework for over 150 years to chart the course of manias, and it's just as relevant today as it was way back then. Okay, so here's how it works. It all starts with displacement, some kind of external shock that creates brand new ways to make a profit. Then comes credit creation. Think of it like this: every fire needs oxygen, and every bubble needs cheap, easy money to grow. This leads straight to euphoria, where prices seem to defy gravity, old-school valuation metrics get tossed out the window, and you start hearing those 4 dangerous words: this time is different. Then you hit the critical stage. This is where the smart money, the insiders, start quietly selling, and you often see fraud start to bubble up to the surface. And finally, you get revulsion. The party's over, the bubble has burst, investors are totally scarred, and nobody wants to touch the asset, which, ironically, is exactly when the real bargains appear.
So once you have this psychological and historical knowledge, you are not helpless. You are not a victim. In fact, you, as an individual investor, have a massive structural advantage over most of the so-called professionals trying to play this game.
See, the professional is a slave to a benchmark. Their biggest fear isn't losing money, it's underperforming the S&P 500. This leads to career risk. If they're wrong and alone, they get fired. They also face business risk. If they sit on the sidelines during a crazy bull market, their clients leave. But you have no benchmark other than your own goals. You have the freedom to be unconventional, to look weird, and you have the patience to focus on the real long term without having to worry about what your boss is going to say in your next quarterly review.
John Maynard Keynes understood this perfectly. He said that the true long-term investor, the one who actually manages to avoid the mania, will always come in for the most criticism. They're going to look eccentric, unconventional, and rash to everybody else who's caught up in the hype. Being willing to look wrong in the short term to be right in the long term, that is a luxury most pros just can't afford. But you can.
So, let's bring this all home. After we've looked at the psychology, the history, and your own unique advantage, what is the single most important lesson you should take away from all of this?
It's this: bubbles are not some mysterious, random act of God. They are not black swans. They are the recurring, predictable, and totally understandable result of human behavior. The details might change, tulips, tech stocks, housing, but the patterns of our psychology, that mix of optimism, myopia, and self-interest, stay eerily the same every single time. The key isn't to predict the exact top, it's to recognize the pattern.
And I just want to leave you with this final thought from the legendary investor Jean-Marie Eveillard. During a bubble, everyone gets obsessed with the odds of it continuing. What are the chances I can make more money? But he says that's the wrong question. The right question is, what are the consequences if you're wrong? Because sometimes the potential damage, the long-term fallout, is so devastating that you simply can't afford to ignore it, no matter how great the party looks today.
You ever look at history and just think, we're stuck on a loop? Especially when it comes to money. You know, we see the same kinds of bubbles and crashes, from the South Sea bubble way back in the 1700s to the dot-com bust, and yeah, even the more recent credit crises. It's this incredible and honestly kind of frustrating puzzle. We have centuries of data, right? So why do we, as a collective, keep making the exact same financial mistakes over and over again? And this quote from the legendary investor Jeremy Grantham, man, it just hits the nail on the head. We get this sharp, painful lesson, a market crash, a bad investment, and we promise ourselves never again. But as time goes by, that memory, that lesson, it just kind of evaporates. History shows us without fail that eventually the lesson gets forgotten.
So that really brings us to the core question we're tackling here. Why? Why do we do this? Is it something wrong with our economic models? Do we just not teach history well enough? Well, the answer, it turns out, is a lot closer to home.
And here's the thing.
The research is pretty clear that the problem isn't a lack of information. I mean, we have libraries full of books analyzing every past failure. Now, the real culprit? It's our own psychology. The very way our brains are wired actually sets us up to fail, forget, and then, you guessed it, fail all over again.
So, we're going to zoom in on two powerful cognitive biases that are constantly getting in our way. First up, you've got the self-attribution bias. That's kind of like your internal PR agent that's always whispering, hey, it's not your fault. Then, you've got its partner in crime, hindsight bias, which is that little voice in your head that, after everything's over, confidently says, oh yeah, I knew that was going to happen. So, let's break these two down.
All right, first up, self-attribution bias. I like to call this one the ego protector because, well, that's exactly what it does. Its main job is to protect our ego from the sting of being wrong.
So here's how it works in the wild. When an investment you make goes through the roof, you pat yourself on the back. It was your brilliant research, your unique insight. You're a genius, right? But when that same investment tanks, oh, well, that was just bad luck. A freak market event. You know, the Fed did something unexpected. Basically anything but your own fault. And we see this everywhere, not just in our finances.
And check this out. This chart shows it so clearly. It's looking at professional athletes and coaches. Now look at that bar on the left. When they won, they chalked it up to their own skill, an internal cause, a massive 80% of the time. But look at the bar for when they lost. All of a sudden, they only blame themselves 53% of the time. That huge gap, that's our ego protector, hard at work. This is exactly why this quote from the famous investor David Einhorn is so incredible. He looked a major loss right in the face and had the guts to say, nope, this wasn't bad luck, this was my bad analysis. He admitted he missed the bigger picture. That kind of brutal honesty with yourself is so rare, but it's the absolute first step to actually learning anything from your failures.
So, how do we, the rest of us, fight this incredibly powerful bias? Well, there's a tool that's surprisingly simple, but also incredibly effective. The Investor's Diary. And if you're thinking keeping a diary sounds a little, I don't know, silly, just consider this. George Soros, one of the most successful investors in history, said this exact practice was a key to his success. He wrote down his thinking in the moment, before he knew the outcome. This forces you to confront your own logic, which makes it way harder to just rewrite the story in your head later on. Now, the real magic of the diary is using it to analyze your decisions with a matrix just like this one. Let's walk through it. Okay, top left corner. If your reasoning was solid and you got a good outcome, awesome. You can probably call that skill. Now, top right. Your reasoning was good, but the outcome was bad. That's just genuinely bad luck. Stuff happens. Okay, now the bottom row is where the real learning is. Bottom left. Your reasoning was totally flawed, but you got a good outcome anyway. That's not skill, my friend. That's just getting lucky, and it's dangerous to confuse the two. And finally, the most important box on this whole grid, bottom right. Wrong reasoning, bad outcome. That is a mistake. And being able to point to it, to own it, that's where you start to actually get better.
Okay, on to our second mental villain, hindsight bias. You probably know this one as the Monday morning quarterback effect. It's that feeling that an event was completely obvious and predictable, but only after it's already happened.
Come on, we all do this. After a big market crash, suddenly everyone's an expert who saw it coming a mile away. And this is so dangerous because it just completely hijacks our ability to learn. Think about it. If you believe an event was totally predictable, what's there to learn? You can't learn from a surprise if you convince yourself it was never a surprise to begin with.
There's this fantastic experiment that shows just how sneaky this bias is. Researchers gave a group of students a pretty complex historical account of a military conflict. First, they asked them to just assign a probability to 4 different possible outcomes. Pretty straightforward. But then they took other groups, told them the actual historical outcome first, and then asked them to assign probabilities as if they didn't already know the answer. They wanted to see if knowing the truth would actually distort their memory of how likely things seemed before.
The results were just staggering. The students who knew the true outcome rated its probability as being nearly double what the other groups did. Let that sink in. They literally could not unknow the truth. Knowing the outcome fundamentally warped their perception of the past. It made the event seem far more obvious and predictable than it ever really was at the time.
Okay, so we've got these two big biases working against us. One that protects our ego by blaming bad luck,
and another that fools us into thinking there was never any real uncertainty to begin with. So how in the world do we fight back and actually learn how to learn?
And this is where it all comes together, bringing us right back to that simple diary. Because the investment diary isn't just a fix for our ego-driven self-attribution bias, it is also the perfect weapon against the memory-distorting power of hindsight bias. Here's exactly why it works so well. It stops self-attribution cold by forcing you to look at your actual reasoning, not the convenient story you tell yourself later. Was your process good or not? End of story. And it completely defeats hindsight bias by creating a perfect time capsule of your thinking. It preserves what you really believed before you knew how it all turned out. You simply can't say I knew it all along when your own handwriting is staring back at you telling you that you didn't. So I'll leave you with this last thought. We've been calling this an investment diary, but let's be honest, it's really a decision diary. If this one simple act, creating an honest record, can protect you from your own psychological blind spots in a world as complicated as finance, just take a second and imagine its power everywhere else. Your career, your relationships, your big personal goals. Where could a decision diary help you finally stop repeating the past? Today we are diving deep into the psychology of investing. We're going to talk about a concept I call ADHD investing, and why sometimes the absolute best thing you can do for your portfolio is nothing at all. So let's start with a kind of weird question. What on earth can a professional soccer goalie teach you about making money? I know it sounds a little out there, but trust me, the answer shines a huge spotlight on a human bias that costs investors a ton of money every single year. All right, let's kick things off with what we're calling the goalkeeper's mistake. We're going to look at one of the most intense, high-pressure moments in all of sports to see a really powerful quirk in how our brains are wired. Okay, picture this, a penalty kick. You've got the ball just 11 meters away from the goal. Statistically, there is an 80% chance the kicker scores. The entire game, maybe even a championship, could come down to this one single moment. The pressure is just immense. For everyone, but especially for that goalkeeper. Now, a study of over 300 professional penalty kicks found something really fascinating. When they mapped out where the kickers were aiming, the distribution was almost perfect. About a third of the time they shoot left, a third of the time they shoot right, and, this is the important part, a third of the time they kick it straight down the middle. It's a totally even split. But here's where it gets weird. Here's the massive disconnect. While kicks go to the center a full third of the time, look at what the goalies do. An overwhelming 94% of the time, they dive. They hurl themselves left to right. They only stay put in the center a tiny 6% of the time. You see that gap? It's huge. And that gap is such a massive missed opportunity, because the data shows that when a goalie just stays in the center and the ball is kicked to the center, they have a 60% chance of making the save. That is a phenomenal success rate in a situation like this, and yet it's the one option they almost never take. So what gives? Why do they jump? Why do they throw themselves across the goal when standing completely still is, statistically, a very strong strategy? Why choose action over inaction when the data is screaming at you to just stay put? Well, the answer is 100% psychological. When the researchers actually asked the goalies, they basically said that diving makes them feel like they're trying. Standing still in the center while the ball just flies right past you, well, that feels awful. It looks like you did nothing. See, taking action and failing feels better than doing nothing and failing. And this whole goalkeeper problem, it reveals something really fundamental about how we're wired as humans. It points to this built-in, deep-seated human bias for action. Action bias is pretty much exactly what it sounds like. It's this internal itch, this urge we all have to do something, anything, especially when we're facing pressure or uncertainty. It's a compulsion to act, even when the most logical, the most profitable choice is to just sit on your hands and wait. And get this, that urge to act gets supercharged right after we experience a loss. As soon as things go wrong, our gut just screams at us to change something, to make a move, to fix it right now. Think about this psychological experiment. You have two coaches, and both of them lose a game. The next week, Coach A shakes things up. He changes his lineup. Coach B does nothing. Then, both teams lose again. When people were asked who they thought felt more regret, a whopping 70% said Coach B, the one who did nothing. The thinking is, if only he had done something, maybe it would have been different. So, after a loss, we see inaction as a bigger failure than taking action and failing again.
Okay, so let's bring this all back from the soccer field to our investment portfolios, because this bias for action, especially right after a loss, is exactly what creates what we're calling the ADHD investor.
So let's just ask it directly. We have this hardwired need to act, to tinker, to meddle, especially when our portfolio takes a hit. Why is that impulse so incredibly dangerous for your long-term financial health?
Because it leads to this. This chart is startling. The average time an investor holds onto a stock has absolutely plummeted. Back in the 1960s, it was over 7 years. Today, it's just 6 months. We've gone from being long-term owners of businesses to short-term renters, constantly trading, constantly acting, all driven by that internal pressure to do something.
And here's the crazy part. This obsession with the short term is completely at odds with how wealth is actually built. You see, over a 1-year period, your investment returns are mostly just random noise, market sentiment, daily news, whatever. But when you look at 5 years or more, 80% of your return comes from 2 fundamental things: the price you paid and the actual growth of the underlying business. By trading every 6 months, we're just gambling on the noise.
And look, this isn't some new problem caused by the internet. The brilliant economist John Maynard Keynes was talking about this decades ago. He said, human nature desires quick results. There's a peculiar zest at making money quickly. That desire for a quick fix, that action bias, it's always been with us.
So what's the antidote? How do we fight this really destructive instinct? Well, the answer comes from some of the greatest investors who ever lived, and it's all about waiting for the fat pitch.
Warren Buffett uses this perfect analogy from baseball. He says, investing is not a game where you have to swing at every single pitch. You can stand there at the plate all day long and let pitch after pitch go by. There's no penalty for not swinging. You just wait and you wait until that one perfect pitch, the fat pitch, comes right down the middle, and then you swing for the fences.
And Buffett actually got this idea from the baseball legend Ted Williams, who literally wrote the book on hitting. Williams's whole secret was this. He mentally divided the strike zone into 77 little cells, the size of a baseball. He knew with absolute certainty which of those cells were his sweet spot, where he could crush the ball. And his entire strategy was to only swing at pitches in that sweet spot and let everything else, even if it was a called strike, just go right on by.
So this really presents a clear choice. It boils down to 2 types of investors. Are you the ADHD investor, driven by that same urge as the goalkeeper, feeling compelled to act, constantly checking your portfolio, and swinging at every pitch just to feel like you're playing the game? Or are you the patient investor, someone who is comfortable doing nothing, who focuses on the next decade instead of the next quarter, and has the discipline to just wait for that one great opportunity?
And that brings us to our final and maybe our most important idea. This isn't just about being patient. It's about truly understanding the immense and often totally underestimated power of doing nothing.
The great economist Paul Samuelson put it perfectly. We've been sold this idea that investing should be exciting, it should be thrilling, full of quick action, but he said the exact opposite. Real, successful investing should be boring. It should feel like watching paint dry. He said if you want excitement, take $800 and go to Las Vegas.
This isn't just an investing problem. It's really a human problem. Centuries ago, the philosopher Blaise Pascal wrote this, and it cuts right to the heart of the matter. He said our inability to simply be still, to just sit quietly and resist that constant urge to act, that's the source of so many of our troubles.
So we'll leave you with this one last thought, a piece of profound wisdom from a pretty unlikely source, Winnie the Pooh. Never underestimate the value of doing nothing. In a world that screams at us for constant action and constant motion, sometimes the wisest and most profitable move is no move at all.
Have you ever felt it? That powerful, almost magnetic pull to just go with the flow? To nod along with the group even when this tiny voice in the back of your head is screaming, wait a second, this doesn't feel right. Well, in the world of investing, that pull isn't just a feeling. It's a force that can have absolutely massive consequences. Today we're going deep. We're going to look inside the mind of the herd and figure out what it really takes to break away.
So here's the game plan. First, we'll explore the pull of the herd. Then we'll look at what's literally happening inside our brains when we conform. After that, we'll see the real-world dollars and cents price of groupthink. From there, we'll flip the script and dive into the contrarian's mindset. And to wrap it all up, we're going to ask a pretty tough question about our own independence. All right, let's jump right in. At our core, we are social animals. That instinct to belong, to be part of the tribe, it runs incredibly deep. But here's the thing. In the world of finance, that very same instinct can be downright dangerous.
I mean, you can't put it much better than Warren Buffett does right here. He's made a legendary career out of independent thinking, and he's seen it time and time again, how even the sharpest minds on Wall Street can get an idea and just stampede together, often right off a cliff.
Now, it's so easy to sit there and think, well, yeah, that's them, that's Wall Street, but not me. I think for myself. But do we really? Are we truly as independent as we like to believe? Well, let's take a look at a classic experiment that really puts that idea to the test.
Okay, have a look at this. The task is dead simple, right? It is painfully obvious which line on the right matches the one on the left. But now I want you to imagine you're in a room with 7 other people, and one by one, they all start picking what is clearly the wrong answer. But they're confident. What do you do when it's your turn to speak?
The results from this experiment are honestly staggering. In Solomon Ash's famous study, a full 75%, 3/4 of all people, went against the clear evidence of their own eyes and conformed with the group at least one time. And you didn't need some huge, intimidating crowd to do it. Just 3 other people confidently giving the wrong answer was enough to make a third of the subjects just give in and follow along.
So this isn't just about being weak-willed or not having a backbone. To really understand why this happens, we have to look under the hood, at what's actually going on inside our brains. Because it turns out, the pressure to conform is a very real biological thing.
You see, we love to believe that we're making a simple, rational choice between A, B, and C. But brain scans tell a completely different story. When we're faced with the prospect of disagreeing with our group, our brain doesn't see it as a logic puzzle. It sees it as a high-stakes emotional battle, a fight between our rational mind and our ancient, hardwired survival instincts.
And this goes deep. Going against the group literally triggers the amygdala. That's our brain's primal fear center. Being socially excluded lights up the exact same regions that process physical pain. To your brain, being rejected by the group feels a lot like breaking your arm. And what happens when we just give in and conform? The parts of our brain responsible for conscious, logical thought, they actually power down. We literally stop thinking for ourselves.
Okay, so we're biologically wired to conform. It feels like fear and actual physical pain to go against the grain. But so what? What's the real tangible cost of giving in? Because in the world of finance, the numbers are absolutely unforgiving.
17%. Just let that number sink in for a second. That represents a massive performance gap created by nothing more than herd behavior among professional, institutional investors.
Here's how it breaks down. The research found that the popular hot stocks that all the big institutions were rushing to buy actually went on to underperform. And meanwhile, the unloved, unpopular stocks that they were all dumping, those ended up outperforming by a huge margin. That 17-point difference is the real price you pay for groupthink. Now, when this tendency to conform gets pushed to its absolute extreme, it leads to a really dangerous state of mind known as groupthink. This is the point where the pressure to agree, to maintain harmony, becomes so overwhelming that it completely smothers critical thinking and rational decision-making.
And groupthink has these classic telltale symptoms. First, there's this illusion of invulnerability. The group starts to believe it just can't fail, which leads to taking insane risks. Then you get self-censorship. People who might actually have doubts just keep their mouths shut because they don't want to rock the boat. And finally, you get these mind guards, people who actively shield the group from any information that contradicts the consensus, basically creating a dangerous echo chamber.
Man, this all sounds pretty bleak, doesn't it? But here is the good news. We can fight back. In fact, the greatest investors in history have built their entire careers on doing just that. So let's unpack the toolkit they use to build and maintain a truly independent mind.
The very first element, and maybe the most important one, is simple to say, but really, really hard to do. It's courage. The courage to stand completely alone, against the roar of the crowd.
This is about so much more than just being brave. It's having the deep conviction to buy when everyone else is in a full-blown panic, or to be skeptical when the market is caught up in euphoria. As the legendary Michael Steinhardt says, it's not always about being smarter. It's about having the guts to trust your own work when the rest of the world is screaming that you're wrong.
Of course, courage all by itself isn't enough. You can be courageously wrong, right? It has to be paired with rigorous, independent, critical thinking.
You can't just be a contrarian for the sake of being different.
True contrarianism means you've got to do your own homework. You have to question the popular story, and you've got to build a rock-solid case for why the market might be missing something. As Joel Greenblatt points out, the whole idea of value investing is built on seeing value where the crowd only sees problems.
And finally, even if you have the courage and you've done the critical thinking, you need the grit to actually see it through. You've heard the saying, the market can stay irrational longer than you can stay solvent. Well, that's where firmness of character becomes absolutely essential.
This means having the patience, the discipline to stick to your process, even when it's painful, and you feel like the only person in the world who sees it your way. It's what lets you hold on to a solid investment when the crowd is screaming at you to sell. The father of value investing himself, Ben Graham, believed this was the single most important quality for success, more than anything else.
Okay, so we've built the toolkit: courage, critical thinking, and firmness of character. But there's one last, sneaky trap that we all fall into. It's the belief that, sure, these rules apply to other people, but not to me.
And our blind spot is huge. Check this out. In one study, iPod owners were asked how much they thought trends influenced their peers versus how much trends influenced them personally. They rated their peers at an average of 5 out of 10, but for themselves, just 3.3. We almost always believe that we are far, far less susceptible to group influence than everybody else.
So we've walked through the psychology, the neuroscience, and the cold, hard financial cost of following the herd. We know what it takes to stand apart. But you know what? Knowing all this, that's the easy part. The real test comes when the pressure is on, when fear kicks in, and the crowd starts to run. The only question left is, when that time comes, which way are you going to go?
Okay, let's talk about one of the absolute hardest, most gut-wrenching parts of investing: knowing when to sell. I mean, why does it always feel like we're programmed to get it wrong? You either sell way too early and watch a stock rocket to the moon without you, or you hold on for dear life as it plummets to zero. Well, that feeling, it's not just in your head. It turns out your brain is kind of working against you, and we're about to see exactly how.
So let's start with a little game. Imagine I'm going to flip a coin. It's a fair coin, 50-50 shot. If it comes up tails, you lose $100. So here's the question for you. What's the absolute rock bottom minimum amount you'd have to win on heads to make you say, okay, I'm in? Now, your rational brain is probably screaming, anything over $100 is a profit. But really think about it. Does the chance to win $101 really get your blood pumping when you could just as easily lose $100? I'm going to guess probably not.
You know, when researchers asked this exact same question to 600 professional fund managers, their average answer wasn't $101, it wasn't even $150, it was over $200. Yeah, these are the pros, people managing billions, and even they needed the potential win to be double the potential loss just to get them to the table. That isn't logic, folks. That's a powerful, powerful glitch in our mental wiring. And it's a glitch that explains, well, pretty much everything.
Well, this glitch has a name. It's called loss aversion. And what it means, in simple terms, is that the pain of a loss feels about twice as strong as the pleasure of an equal gain. It's why losing a $100 bill on the street feels so much worse than the momentary joy of finding one. This one simple idea explains the coin toss. And as we're about to see, it explains some of the biggest, most consistent, and most expensive mistakes we all make with our money. So, here's the game plan. We've just seen this wild 2-to-1 rule in action. Next, we're going to see just how deep this bias runs. It goes way beyond your stock portfolio. Then we'll connect it directly to the costly mistakes investors make before we look at another mental trap that just makes everything worse. And then, the most important part, how do we fight back? We'll check out how the pros try to outsmart their own brains.
Right, so you might be thinking, okay, this is an investing thing, a money quirk. But it's not even close. This bias is so fundamental, so baked into who we are, that it pops up in the most surprising places. Like on the perfectly manicured greens of the PGA Tour, where every single shot is worth a fortune. Check this out. Researchers dug through the data on over 1.6 million putts from professional golfers, and what they found is just incredible. When a pro is putting for par, which means they're trying to avoid losing a stroke, they sink it 86% of the time from this close range. But when they have the exact same putt for a birdie to gain a stroke, their success rate drops to 82%. Isn't that wild?
That's a 4% drop for the same physical action. The fear of taking a loss literally makes them better, more focused players than the excitement of a potential gain.
And this isn't just some statistical anomaly. I mean, listen to arguably the greatest to ever play the game, Tiger Woods. He said it himself. Saving par just feels more important than making a birdie because, in his words, you don't ever want to drop a shot. Even at the absolute pinnacle of human performance, the psychological weight of that loss is heavier than the thrill of the win.
So it affects Wall Street pros, it affects golf pros. But get this bias isn't even uniquely human. Scientists think it could be an evolutionary echo from our deep, deep past. We're talking 35 million years deep. To figure this out, researchers set up a brilliant experiment with capuchin monkeys, who are one of our distant evolutionary cousins. They gave them a choice between two games, both with the same odds. In game 1, the monkey gets 1 grape, with a 50-50 chance to win a second one. That's the gain frame. In game 2, the monkey starts with 2 grapes, with a 50-50 chance to lose one. So, what happened? The monkeys hated the loss game. They consistently avoided the researcher who offered the bet where they could lose something they already had. This tells us it's probably not learned behavior, it's a primal, hardwired instinct to avoid loss at all costs.
Okay, so we've seen that loss aversion is deep, it's primal, it's powerful. So what is this 35-million-year-old instinct actually doing to your investment portfolio? Well, let's bring it back home, because the mistakes it causes are very real. And as you're about to see, they are very, very expensive. This primal fear of loss is the fuel for one of the single most destructive biases in all of finance. It's called the disposition effect. You know the old saying, cut your losers short and let your winners run? Well, this bias makes us do the exact opposite. We rush to sell our winners to lock in that little hit of pleasure from a gain, but we cling to our losers for dear life, because selling them would mean we have to actually admit the loss is real, and that just hurts too much.
And the data on this? It is crystal clear. A huge landmark study looked at thousands of individual brokerage accounts and found that, on any given day, investors were selling off 15% of their winning stocks, but only 9% of their losing ones. Just let that sink in. People were almost twice as likely to sell a stock that was making them money as they were to sell one that was failing. That, right there, is the disposition effect in the wild.
Now, it's really easy to say, okay, that's what amateurs do, but the research shows even the pros fall for it. Looking at a huge sample of mutual funds, professional managers were still 1.2 times more likely to sell a winner than a loser. But here's the real kicker. When they zoomed in on just the worst-performing professional managers, their behavior was identical to the individual investors. They were 1.7 times more likely to sell a winner. This bias isn't just a quirk, it's a huge red flag for poor performance. So what's the actual damage? What's the real-world cost of making this mistake over and over? Well, that same study tracked what happened next. The winning stocks that people sold too early went on to beat the losing stocks they desperately held onto by a whopping 3.4% per year. Now, that might not sound like a huge number, but you compound that over 20, 30, or 40 years of investing. That is a fortune left on the table. This isn't just a mental tick, it's a wealth-destroying machine, quietly humming along in the background of your portfolio.
So as if loss aversion wasn't a big enough hurdle, there's a second psychological trap that works right alongside it. It's a sneaky bias that kicks in the second you own something, and it completely distorts your judgment, making it even harder to let go.
It's called the endowment effect, and simply put, we fall in love with our own stuff. The simple act of ownership makes an object, whether it's a coffee mug, a concert ticket, or a share of stock, feel more special, more important, and more valuable to us than it does to anybody else. We get irrationally attached, and the idea of selling it feels like a much bigger deal than it really is.
The most famous experiment to show this is just beautiful in its simplicity. Researchers walk into a classroom and they randomly give half the students a simple coffee mug with the college logo on it. Then they go to the students who got a mug, the sellers, and ask them to write down the absolute lowest price they'd sell it for. Then they go to the other half of the class, the ones who didn't get a mug, the buyers, and ask them for the highest price they'd be willing to pay for one. And the results are just staggering, every time. The sellers, who'd owned this mug for maybe 5 minutes, said on average they wouldn't part with it for less than $5.25. The buyers? They valued that exact same mug at only $2.50. The mere act of ownership, of it being their mug, more than doubled its perceived value. Now just think about how much stronger that effect is for a stock you've spent weeks researching and have owned for years.
So, we have our villains, loss aversion and the endowment effect. They're powerful, they're primal, and they are costing us money. But we're not helpless. The good news is we can fight back. So let's look at a couple of mental models that the pros use to battle these exact same biases every single day.
I absolutely love this framework from hedge fund manager Lee Ainsley. His rule is simple, but it is so profound. In his portfolio, there is no such thing as a hold. For every single stock he owns, the question every day is not, should I hold this or sell it? No. The question is, if I were 100% in cash right now, would I buy this stock at this price today? If the answer isn't a loud, enthusiastic yes, then he sells. It's an absolutely brilliant way to just slice right through the emotional fog of the endowment effect.
Here's another super useful idea, this time from investor Christopher Brown. He says you can't have one selling rule for everything. You have to know what kind of asset you own. He puts them in two buckets. First, you have cigar butts. These are cheap, beaten-up stocks that maybe have one last good puff left in them. For those, the rule is easy. You sell when the price gets back to what you think it's actually worth. But then you have compounders. These are amazing businesses that can just grow and grow for decades. You don't sell those just because the price went up. For those, you only sell when you find another, even better opportunity for that money. And in the end, it really all boils down to the timeless wisdom of Kenny Rogers, right? Because what he's really singing about isn't just a poker game. He's describing the core challenge of being an investor. It's a game that's played, not at a table, but in the 6 inches between your own ears. And winning that game starts with knowing exactly what biases you're up against and having a plan to deal with them.
So let's end with a direct challenge for you. Go look at your portfolio, every single stock, every fund, and ask yourself that one tough question for each of them. Are you holding onto this just because you already own it, because you're caught in these psychological traps? Or would you, with fresh cash in your account today, enthusiastically buy it all over again? I promise you, the honesty of your answer will tell you everything you need to know about when it's really time to fold them.
Have you ever made a really bad decision that somehow worked out perfectly? Or maybe you've had the opposite happen. You make a brilliant choice, everything's lined up, and it just completely fails. Well, that's exactly what we're diving into today. We're going to explore why the path you take is so much more important than where you end up. We're talking about focusing on the one thing you can actually control, your process.
Okay, so here's our game plan. We're going to start with a pretty wild story from a casino. Then we'll introduce a really powerful tool called the decision matrix. After that, we'll unpack a tricky mental trap that gets all of us. And finally, we'll look at how focusing on your process, not the prize, can lead to much more consistent success in the long run.
All right, so our story begins in a place where logic often goes to take a little vacation, a packed Las Vegas casino. It's here that a single hand of blackjack reveals a fundamental and kind of uncomfortable truth about how we judge both success and failure. Just 2 little words. Nice hit. But these 2 words, spoken by a blackjack dealer, sparked this huge realization. They perfectly highlight the dangerously blurry line between what makes a good decision and what makes a good outcome.
So picture this. It's a busy Saturday night. The casino is absolutely buzzing. And at one of the blackjack tables, there's this guy who's clearly had a few too many drinks, and he is just hemorrhaging money. And then he gets dealt a 17. Now, for anyone who knows even a little bit about blackjack, a 17 is a hand where every single book, every expert screams, "Stand, do not take another card." And here's where it gets crazy. The guy ignores all logic. He even gets a warning from the dealer, who literally stops and asks him, "Sir, are you sure?" But he insists. He demands a card, and, against all odds, a 4 lands on the table. Boom, 21. The table goes nuts, everyone's high-fiving him. But let's ask the real question. Was it a good decision? Absolutely not. It was a terrible, statistically awful process that just happened to lead to a fantastic outcome. Okay, so to make any sense of what we just saw happen at that blackjack table, we're going to need a better framework. We need a way to untangle the quality of our choices from the pure random luck of the results.
And this isn't just for casinos, you know. This tool comes straight from the worlds of pro sports and high-stakes investing. We're talking about leaders like Paul DePodesta. You might remember him from the book and movie Moneyball, who have to evaluate massive decisions under incredible uncertainty.
This matrix is brilliant. It gives us 4 quadrants for any decision. You have a good process that leads to a good outcome. We call that deserved success. Then there's a good process that, just because of bad luck, leads to a bad outcome. That's a bad break. On the flip side, a bad process leading to a bad outcome, well, that's just poetic justice. But it's that last box, that's the one that's the most dangerous of all.
And this right here is the key distinction. Deserved success is something you can repeat. It's what championship teams and, ironically, casinos are built on, a solid process that wins over the long haul. Dumb luck, on the other hand, well, that's our blackjack player. It feels amazing in the moment, but it teaches you all the wrong lessons.
And here's why that's so dangerous. Success can be a lousy teacher if you don't look at the right way. When we win because of dumb luck, but we tell ourselves it was because of our skill, we reinforce a bad process. And that bad process will eventually and inevitably lead to failure.
This whole problem, this failure to separate what was luck from what was skill, is actually rooted in a really powerful psychological glitch. It's a bias that affects almost every single decision we make and evaluate.
So this is what's called the outcome bias. Basically, it's our brain's lazy shortcut. If something worked out well, we just assumed the decision-making behind it was brilliant. If it failed, well, the decision must have been terrible, right? We end up judging the past with the knowledge of the present, which is something the person making the decision never had.
Let's make this really concrete with a thought experiment. A doctor performs a necessary operation. There's a known, small risk of death, let's say an 8% chance. Now, the doctor's process is exactly the same in two scenarios. Same information, same call. The only thing that changes is the outcome.
So think about it honestly for a second, how you rate that doctor's decision. Studies have shown that when the patient lives, people rate the decision as clearly correct. But when the patient dies, that rating absolutely plummets to incorrect. The process was identical, but the outcome completely changed our evaluation. That right there is the outcome bias in action.
So what happens when we live and work in a world that only seems to reward outcomes, like in business or investing or politics? Well, it systematically encourages really bad decision-making.
See, if you know you're only going to be judged on the final result, you start playing defense. You start avoiding ambiguity, picking the sure thing with a low payoff over a smart, calculated risk with a much higher potential. You start collecting useless information, not to make a better decision, but just so you have something to point to if things go wrong. You prefer compromise, not because it's the best option, but because it's the most defensible. You start herding with the crowd, because hey, if you're wrong along with everybody else, at least you won't get singled out for blame. It's really just a recipe for mediocrity.
So if judging everything by the outcome is so bad, what's the alternative? Well, there's this really elegant experiment involving a brewery that gives us a very clear path forward.
Okay, so here's the setup. Imagine you made an initial investment in a new beer, and it didn't do so well. Now you've got another $10 million to allocate. The big question is, are you going to double down on your past mistake to try and prove you were right, or are you going to follow the new data? And here's the crucial part. One group was told they'd be judged on the final results, while the other was told they'd be judged on the quality of their decision-making process.
And the difference? It is just staggering. The group that was held accountable for the outcome threw an average of $5.8 million more at the failing beer. But the group that was told to focus on their process, they were much more rational. They only allocated $4 million to the original beer, and they shifted the rest to a better option.
What this shows us is that being held accountable for having a good process actually frees us up. It liberates us from having to defend our past mistakes, what's known as the sunk cost fallacy, and it allows us to make the best possible choice based on the information we have right now.
So let's bring this all home. This isn't just some academic theory. This is the core philosophy of some of the greatest investors who ever lived. They all knew that you can't manage the final return directly, but your process, that's something you can work on and perfect.
I absolutely love this quote. It comes from a story told by the legendary investor Benjamin Graham. A man wins a hand of bridge, and he's bragging to his wife, who just looks at him and says that his successful outcome was pure luck, and that a proper, well-played process would have actually lost that hand. It's just a perfect reminder that sometimes you can do everything right and still get a bad break, and that's okay.
And this piece of brilliant advice from Sir John Templeton really is the ultimate call to action. It's easy to analyze our failures, but it's much harder and way more important to really dissect our successes, because that's where you find the hidden dumb luck, and that's how you make sure you're not accidentally reinforcing a bad process.
And so we'll leave you with that question to think about. Take a hard, honest look at your recent wins, whether it's in your career, your investments, or just your life.
Which of those were truly deserved success that came from a sound process? And which ones were just a lucky roll of the dice? Because knowing that difference, well, that's everything.
Hello and welcome. You know that feeling, right? You make a plan, you're going to eat healthy, you're going to save money, you're definitely going to start exercising, and then a week later you look back and oops. It's this incredibly frustrating, super common gap between what we know we should do and what we actually end up doing. So today, we're going to get into exactly why our best intentions fall apart, and this is the important part, what we can actually do about it.
All right, so here's our game plan. First, we're going to put a name to the problem. It's called the intention-behavior gap. Then we'll look at all the sneaky little biases that mess with our heads every single day. We'll even see what happens when the stakes are literally life and death. After that, we'll figure out why our good intentions crumble, and then we get to the good stuff, how to actually turn those intentions into actions, and finally, how to become your own biggest supporter instead of your own worst enemy.
So to really get this, let's start with a little confession. It's a perfect, and I'm guessing a very, very relatable way to frame this whole struggle.
I love this. The author of our source material just comes right out with it. He knows exactly what he needs to do to solve his problem. Eat less. Simple, right? The knowledge is there 100%. But as he says, that knowledge just doesn't seem to translate into better behavior. He basically files that information away under a folder in his brain called Things I Know and Actively Choose to Ignore. I mean, who hasn't been there? And this whole thing actually has a name, the intention-behavior gap. It's that huge, empty space between our grand plans and our real-world actions. It's the reason we have gym memberships that just collect dust, and it's why we know we should be putting money away for the future, but that pizza delivery app is just so easy to open. You know, just giving it a name helps you realize, okay, it's not just me. This isn't some personal failure. It's a totally predictable part of how our brains are wired.
Now this is where it gets really interesting. This isn't just about willpower. It turns out our environment and our own minds are like a minefield of hidden tripwires, constantly pushing us toward mindless decisions, and usually in the wrong direction.
There's this great book, Mindless Eating, by a researcher named Brian Wansink, and it shows just how easily our environment plays us. One of the biggest factors? Simple availability. Whatever's easiest, whatever's right there in front of your face, that's what you're probably going to grab, whether it's a snack or the news you read or anything else.
And get this is a perfect example. A study found that people ate almost 3 times as many chocolates when the candy dish was sitting right on their desk, clear as day, compared to when they had to get up and walk just a couple of meters to get one. That tiny bit of effort, or, lack of effort, had a massive effect on what they did. It had nothing to do with hunger, really. It was all about convenience. And check this out. This is the power of suggestion, what psychologists call anchoring. So, in a supermarket, they put soup on sale. At first, there was no limit, and people bought, on average, about 3 cans. But then they put up a little sign that said, limit of 12 per person. And what happened? The average person started buying 7 cans. That number 12 just got stuck in their head as the new normal, and boom, sales almost doubled.
So it's not just what we see, it's who we're with. That herd instinct is so powerful. The data shows that when we eat with just one other person, we eat about 35% more than we would if we were alone. And if you're in a big group, say 7 or more people, you're probably going to eat nearly twice as much. We just can't help it. We unconsciously start to mirror the people around us.
Okay, so chocolates, soup cans, that's all one thing. But what about when things get really serious? Like really serious? Surely, when the consequences are actual life or death, our rational brain just takes over and makes the smart choice, right? Well, let's see what the data has to say about that.
Wow, this is pretty sobering. In Botswana, they looked at HIV prevention. Over 90% of men and women knew that condoms work to help prevent transmission. So pretty much everyone knew what to do. The knowledge was there. And yet, only 70% of men and just 63% of women were actually acting on that knowledge. This is just such stark proof that even when our lives are on the line, just knowing something isn't enough to make us do it.
And that leads us to a really tough, but honestly, a really crucial realization. If knowing something that could save your life isn't enough to guarantee you'll do it, well, then what chance do our little promises to ourselves stand? Our New Year's resolutions, our vows to start fresh on Monday, they're just built on even shakier ground. We all have good intentions, but those intentions almost never survive first contact with reality.
Okay, let me give you another fantastic example of this. In a study, they asked people if they intended to donate blood. The group that was the most enthusiastic, the ones who said, yes, I absolutely plan to donate, they predicted there was about a 90% chance they'd actually follow through. They were so sure in that moment, they really felt it.
But then, here comes reality. Of that exact same group, the most motivated people in the study, only 40% actually went and donated blood. Now, they weren't lying when they said they intended to. They really truly meant it. But that strong feeling of intention was just a terrible predictor of what they would actually do later.
So what in the world is going on here? Why is there this huge, predictable gap between what we plan to do and what we actually do? Well, the answer comes down to this fundamental mistake we all make when we think about our future selves. So here's the key, right here. We make this critical error. We confuse how strongly we feel about doing something right now with the actual odds of us doing it in the future. So when we say, that's it, I'm starting my diet tomorrow, we feel this powerful, sincere rush of commitment. And then we take that feeling and we think, oh yeah, future me is totally going to crush this. But we forget that future me won't have that same fresh motivation. Future me is going to be tired and stressed and tempted by a donut.
Let's just be blunt about it. We are all massive optimists when it comes to the willpower of our future selves. We picture this amazing future version of us who is disciplined and motivated and can resist any temptation. The only problem is that person almost never shows up for their shift. We systematically underestimate how hard it's going to be and overestimate our ability to handle it.
Okay, that was all the bad news. We put a name to the problem, we've looked at the biases, we understand the psychology. But what's the solution? Let's switch gears and talk about how we can finally actually build a bridge across that frustrating gap between what we intend to do and what we actually get done.
This is it. This is the big question, right? If we can't just rely on knowing more, and we can't rely on our good intentions or our willpower, what's left? What actually works? Well, the answer isn't about just trying harder. It's about thinking smarter. It's about building a better system for yourself.
And the answer is process. A process is basically just a set of simple, predefined rules that you commit to ahead of time. It takes the decision out of that hot moment of temptation. So instead of counting on your future self to have amazing willpower, you just rely on a system that your calm, rational self already built. It's like a defense mechanism against your own worst impulses.
Let's go back to dieting because it's a perfect example. So instead of just intending to eat better, you build a process. Rule number 1, use a smaller plate. It's a simple hack that makes smaller portions look bigger and more satisfying. Rule number 2, no matter what, half your plate is always vegetables. It's simple, it's a rule, you don't have to think about it. And rule number 3, don't try to change your entire life overnight. Just focus on like 3 small things at once. That's what makes it doable.
And this isn't just for dieting, this is how the best of the best operate in really high-stakes fields like investing. They do not trust their gut feelings in the moment. They build strict processes with hard and fast rules. Sir John Templeton had a rule to force himself to do research when everyone else was panicking. George Soros kept diaries to call himself out on his own bad thinking. Bruce Berkowitz has a process where he actively tries to find reasons to kill an investment just to test its strength. They all know they can't trust themselves when things get crazy, so they trust their process instead.
Okay, let's bring this all home. We've gone from a simple confession about wanting to lose weight all the way to the world of high-stakes finance. And through it all, there's been one single powerful lesson.
In the end, it becomes pretty clear that when it comes to reaching our long-term goals, our biggest obstacle is us. Our own impulsiveness, our ridiculous optimism, all those mindless biases. But the solution is just as clear. By taking the time to design and commit to a process, you stop fighting against your own weaknesses. Instead, you build a system that makes doing the right thing the easiest thing to do. You literally transform your own worst enemy into your most reliable, most effective ally.